coming up here on the Bank of England, I'm going to have John bring in our esteemed guest, other than to say, Capital Economics does terrific, thoughtful research. They go deeper, and it's always been a joy, really, from day one. And John, to me, what the backdrop here is when you speak to Jennifer McCown, their chief global economist, you have to ask her, did you take the train today? Or do we need to ask Governor Bailey? How did you get to work today, Governor Bailey?
He lives on Threadneedle Street.
This is not like the presser yesterday. The Bank of England is a central bank with a labor crisis of some sort that others don't face.
I think Chairman Powell talked about two-sided risks, or at least reflected on two-sided risks.
Yeah.
I think there's multiple risks in the UK right now. Jennifer McKeown joins us. Jennifer, fantastic to catch up with you. Can you tell us these multiple risks that this governor of this Bank of England has to face down today, and ultimately what they'll decide to do?
Yeah, that's right. And what's really interesting about these strikes, we've had nurses strikes, teachers strikes, rail strikes, is that on the one hand, they're weighing on activity, so they make the near-term outlook for the UK economy look even worse. But on the other hand, they're further evidence of the tightness of labour markets in the UK, this real push for stronger wage growth. And I think now labour markets feel tighter than they are in the US, so that the Bank of England's really got a bit of a dilemma on its hands. We think it's going to go for another 50 today, but the peak might not be too far off, given just how weak the economy looks.
Jennifer, what is business investment in the United Kingdom? All the, not Brexit gloom articles, but the tone that I get out of the United Kingdom, if you're not 47 blocks outside London, is there's a dearth of business investment. Is that true?
Yeah, well, definitely business investment has been weak in the UK. That partly relates to Brexit, but of course it relates to all sorts of headwinds the UK economy has been facing, including the surge in gas prices, the energy crisis here. So there are a lot of good reasons to hold back on investment, and with interest rates rising, that obviously just adds to those, and that's something businesses are very much aware of. So the bank's got a really careful tightrope to walk here, where it indicates that it is on top of inflation, but the rates aren't going to go sky high and stem any investment that may have been forthcoming.
Jennifer, explain to our audience the Bailey-Powell distinction, in that Governor Bailey has to worry about a floating rate.
Variable interest rates, so UK interest rates. There's been a real risk of housing slumps. Now, that has changed a bit in the UK. We've shifted more towards kind of 2-year fixes, but that's still not as long as the situation in the US, where mortgages in particular tend to be on longer fixes. The pass-through from interest rates is maybe a bit slower. So the bank's also very much got the housing market on its mind. House prices are already falling here, so it's going to need to be very much aware of how its policy is affecting people's interest rate costs and knocking onto the housing market.
Jennifer, I remember about 6 months ago when we were talking about how all central banks were hiking into weakness, and now it seems like the U.S. is pausing into strength. The ECB is hiking into more strength, and the Bank of England is very alone, hiking into true weakness, even with the IMF predicting an ongoing recession and deepening there. How does that complicate how far they can raise rates, considering that inflation has continued to surprise to the upside?
Yeah, it definitely complicates the story further. The picture in the UK is much more clearly one of a weak economy that's heading into, or indeed already in, recession. But I don't think that's far off in the US or the Eurozone either, to be honest. I think that there are plenty of indications that the US economy will still suffer a recession, and I think the Eurozone's had a temporary reprieve. Yes, the Q4 figures were a bit better than we might have thought, but I think just given the extent of the squeeze on real income from the energy crisis that we've had and the policy tightening we've already had, a recession's coming in the Eurozone too. So I think all central banks are going to be in a similar position. Key issue, of course, is the extent to which price pressures are coming off, and it's much clearer that that's happening in the US than it is in either the Eurozone or in the UK.
Do you think that economists, including at the Bank of England, are overestimating or underestimating how deep the recession in Britain will be?
Well, the Bank of England's forecasts have been very pessimistic until recently. It had a recession lasting about 8 quarters, encompassing, I think, a 3% peak to trough fall in GDP. I don't think it's going to be quite that bad. And indeed, its forecast will probably show that. Its new set of forecasts will probably show that the recession is going to be shallower than previously feared, partly because the data we've had haven't been quite so awful as we thought they might be, but also because markets are now pricing in a much lower path for interest rates than they were, given that the Bank of England's forecasts are predicated on market interest rates. That will have a big bearing on where it sees the economy going. So I think we might see some relief in those terms, and perhaps the ECB's forecasts look relatively gloomy now, given the data that we've had.
Jennifer, wonderful to get your insight, as always. Jennifer McKeown there of Capital Economics. Tom, the decision from the BOE, 7 minutes away.
Give us your perspective on this. I mean, your dinner alone that you had in Mayfair is going to keep the UK out of recession. We understand it. It moves the GDP needle. But, John, you were there, and to Lisa's wonderful question, all I'm seeing is gloom, gloom, gloom. Oh,
Sure.
It's not as bad as we thought. And I believe I just heard that from the Capital Economics.
You say that I was there, so let's talk about where I was. I was commuting between a hotel and going into the office. I've not seen the rest of the country. I've not experienced what people are going through right now.
So that's all I do, and I talk like I'm an authority.
And we can joke about it, but ultimately we're all on the same page.
Yeah.
There's a lot of people really struggling right now in the UK to pay their energy bills. There is a real fear that once those 2-year fixed mortgages, if you've got a 2-year fix, once you have to remortgage, and you're looking at 4% bank rate at the Bank of England, maybe in about 5 minutes, that's a real problem for a lot of people.
So somebody's got like a 2 or 3% mortgage rate, and it becomes 5%. Is that rough math?
Could be lower than that, Tom. I'm not sure what they negotiated at the time or how long the fix was, but sure. I think the difference here, and Jennifer was talking about it and you alluded to it, is that the floating rate mortgage, the variable rate mortgage, tracks bank rate and not the market. And bank rate is what the Bank of England decides rates actually is. And that's where you get your adjustment. The other issue, and Jennifer also touched on this as well, is the proportion of the gilt market, which is indexed to inflation. So that's actually got a little bit better over the last couple of months. The fact that we're not facing down the forecast for inflation in the UK. Yeah. Some banks were talking up maybe close to 20%. So we can talk about good versus bad. It's not good, but it's certainly better than it was a few months ago.
The tail risk, though, here is the energy prices. And I don't mean to be Miss Gloom. And honestly, it's really wonderful to see that the economic data is coming in stronger than a lot of people expected. But if there is a colder bout, not just, for a couple days, if there is a bigger disruption, does that change the whole narrative around this optimism? Tom?
I'm waiting for John to answer because I think he's got a really special thing. John, what's so important here, and I've actually had the honor of talking to Governor Carney about this. There's London, which is our perception, and there's everything else. And the everything else is really, there's a real distinction.
I feel like I'm doing Governor Carney's greatest hits, but there was a news conference, I think maybe 2014, and there was a problem with house prices in London. They were absolutely surging by 20, 30%. And Governor Carney had this great line. And if you understand or are familiar with the tube system in the City of London, he said, I don't set policy for inside the Circle Line. And the Circle Line just goes around the centre of London. And that was his message. I don't set policy for inside the Circle Line. Isn't that a great line?
One day I got in the Circle Line.
You just went round.
I went all the way around.
I can imagine that. Kit Juicer SocGen coming up. A Bank of England rate decision up next.
The top names in global leadership are on Bloomberg.
I very much support the idea of a stronger sovereign geopolitical European Union. Democracies should cooperate, and that they should understand that there is something we have in common: respect for the individual rights of man, being in favor of the rule of law.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
DPDHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We continue to anticipate that ongoing increases will be appropriate.
This is a Fed that really has been pushing back, particularly on the easing of financial market conditions.
What the markets heard was this issue of the conflict between financial conditions easing and whether or not that would impact the Fed's policymaking.
If price inflation continues to come down as it has, it does open up a greater path to a soft landing. People forget that you can have a recession, and while it's going on, you don't know you're in it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
This show is such a mess this morning. Someone flew Guy in.
He said, please, HR called up and said, please.
On Boeing's last 747. I thought that was really special. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Guy Johnson alongside us here in New York as the Bank of England makes the decision, Guy, to hike interest rates once more.
50 basis points. And that sounds, that the statement, the commentary feels much more hawkish than I think a lot of people were anticipating. A lot more hawkish. So they've gone by 50. They're saying inflation risk skewed significantly to the upside. They're saying that they're going to require further tightening. The expectation was potentially we could get 50 and maybe 25 after that.
Right.
Further tightening, maybe you could still put 25 in there, but this sounds more hawkish to me. Pound's gaining on the back of it.
And one question I know, I want John to do the markets because the screen's lighting up like a candle. As simple as this, it's assumed, Guy Johnson, that the Fed speakers will walk back some of the tone that we saw from Chairman Powell. Yep. In the United Kingdom, do the various people of the Bank of England walk back what the governor may say today or what this statement says?
Okay, so the vote split 7-2. So remember, it was a three-way split last time.
Two. You're wrong, Bailey.
Did you just bark?
Yes.
I think he did.
I love it.
It sounded like it, didn't it?
I'm
I think he's implying that I barked.
It's like Game of Thrones. I love the dissent.
We would never do this with the Fed. The disrespect. Carry on, Guy.
7-2. So I'm assuming that you've got Tenrey and Dingra still voting for 25. Sorry, they're unchanged. Actually, it's a 7-2, so maybe they voted for 25.
No, they both went unchanged, Guy.
They both went unchanged. Yeah. Okay. So that means Mann's come down
to 50
from
75, yeah.
To a 75. So it feels more of a coalesced Bank of England. But it still feels slightly more hawkish than I think we were anticipating.
Guy, talk to us about the data, the backdrop for the data in the UK right now. Talk to us about what the United Kingdom and this Bank of England is confronting, and the difference maybe between the UK and what's happening here in the States.
I think there are similarities, so let's actually start there. I think it's about the labour market. I think that is where the ultimate problem lies for the Bank of England. You've got a whole load of people that are over the age of 50 that have left the labour market and don't want to come back. You've got a very, very tight labour market as a result of that. And that is, I think, probably one of the primary focuses of the Bank of England right now. They are talking about a shorter, shallower recession than the November outlook. So you would, if you're getting a shorter, shallower recession, that means in theory you're getting more demand, right? So that's going to, in theory, push the inflation a little harder than you originally would have got with that deeper recession, which would have curtailed the inflation. So in some ways, there's more of a demand push, sort of demand pull story here within the inflation outlook. So yeah, I think this sounds like this is a Bank of England that wants to do more, needs to do more, certainly judging by the numbers that they're pushing out today.
How much were they basically given a bit of a pass to do this because of energy prices, because of China reopening? And I say that because everyone seems to suggest a shorter and shallower recession, and a lot of it hinges on those two factors.
I think energy, yes, China less so. I think China's a bigger factor for the ECB. I think it's less of a factor for the Bank of England, only because we're not the kind of industrialized economy that Germany and its hinterland represents. But I think the Bank of England, will have looked at the energy story. But the energy story again is it's going to allow people to spend more, Lisa. And that, in theory, should be pushing the inflation narrative a little bit harder. So it brings down headline inflation, but does it encourage core inflation to stay maybe a little bit stickier?
So we were talking about dovish versus hawkish. It's very hard. Those words are kind of losing meaning at a certain point when we're parsing throughout all of the minutiae. The pound was briefly gaining, then it was losing, then it was gaining. I mean, it's really fluctuating now. It's a little bit down versus the dollar. Catherine Mann, how much does she hold the keys to the interpretation, the fact that she dropped her vote down from 75 basis points to 50 with the most, the core of the group?
Well, I think she's signaling a reality of an economy slowing down. And I think that just is the practicality of the situation. They have dropped a bit of language out of the statements, it looks like. It looks like they have dropped forcibly, which the market was paying attention to in terms of the way that we should interpret what they've said today. So in terms of how the language is changing around this and the interpretation they're trying to put on it, they have taken down the emphasis on the need to hike a little bit further. So I started off saying this felt a little bit more hawkish than anticipated. The fact that they've dropped forcibly maybe just detracts a little bit from that. But I think Mann is interesting. I think she's just reflecting reality. She was at one tail. She's now coming back into the consensus. But the consensus, that the core of the group is still around 50. You've only got two outliers at the moment.
The nominal GDP story, there's an assumption of the ECB coming up that they don't have the power, the economic power for a higher rate regime. Some agree, some disagree. In the United Kingdom, is the oomph there as a total country to withstand these rates?
Well, John was talking through the impact on the mortgage market. It is going to have a significant impact, but it is going to be offset by lower energy costs. And it's going to be interesting to see what wages look like. So there's a kind of balancing factor that could come through here. And I think the bank's going to be watching wage growth. But at the moment, you've got a real income squeeze. So people are going to be hit by these higher costs. But in some ways, that's what you need. That's the objective here. You have a relatively fast transmission through the mortgage market into the real economy.
We should do this every month, Guy. This was great.
Fly him in, just on a Boeing 747.
Sure.
And Tom Barks.
You know.
And was
that was new for me.
That was a growl? Or
that was a dissent. That was a dissent.
That was a dissent.
Yeah, I'm sitting at home and, cash flow wants to do something. Like,
But you growl at your own dogs.
Like my children.
Okay.
The dogs don't growl, it's Tom.
It's only 7:06 here in New York. I have no idea how we're getting through to
Guy
the
will stay with
ECB
us.
news conference at 8:45. The news conference begins with Governor Bailey and when? Guy, 23 minutes?
Well, yeah, 25
something
minutes.
like that. All right. Kit Jukes joins us now, Chief FX Strategist at SocGen. Kit, wonderful to have you with us. Your response to that decision this morning from the BOE?
Yeah, I mean, it's not a massive surprise. They were expected to go 50. We're looking for another 50 after that. I'm not sure we're going to change our minds in terms of what comes next. It does sound a little bit more upbeat, but one of the big surprises at the back end of last year, not just in the UK, but right the way across Europe, was that when energy subsidies came in, people didn't move their growth forecasts up. The consumer got protected from the worst of the energy crisis. We get bigger deficits, bigger trade deficit in the UK, but more GDP temporarily. Coming into this year, I mean, the biggest surprise to me of all is how well European industry is doing at weaning itself off gas and how that relieves the pressure around Europe from the energy crisis. And it probably means the UK has a longer but shallower recession than anyone else. But where does that leave the Bank of England? Still with more to do, yes, but still with a recession. And maybe the only thing for the currency that's important is that everyone is so bearish that it has a cushion.
So meanwhile, in the U.S., we're talking about long and variable lags. When it comes to the United Kingdom, when will the full thrust of what we've seen with rate hikes hit the economy in a way that hasn't yet fully been seen?
It feeds through faster than other countries because we've got a floating rate mortgage market, as you discussed. I think there's no doubt about that. It feeds through the currency quite quickly, which has an impact on other things, some good, some bad. But for the rest of it, we have the same fundamental issue, I think Guy mentioned it, as you have in the United States. If your labor market is so tight that there are more jobs for people available than there are people looking for them, your economy can't fall right off the edge of a cliff just like that, because it's the combination of a rising mortgage rate and losing your job that people of my generation can remember from the end of the 80s and the beginning of the 1990s as being utterly devastating. We're going to have half of that for people, albeit at lower mortgage rates. It's when the labor market breaks that we really, really struggle. So far, that's not what's happening.
Kit Jukes, the velocity of what we observed yesterday, just simply your thoughts on the moment of 2:45 p.m. yesterday, Wall Street time, when markets seized and moved?
To my mind, we could talk about it a lot, but I was surprised at the scale of the reaction to a Fed decision that was so close to expected as makes no odds. The minor tone that Chair Powell didn't push back aggressively at some of the questions about sort of dovish bias questions about whether the labor market is going to be okay with wage growth easing off even at low unemployment. The market really sort of grabbed hold of all that. So it seemed quite euphoric to me. So we spent after that, but the decision itself wasn't a big surprise.
But no matter the ebb and flow, BBDXY is down 11%. We've got weak dollar down 11% from its peak, the drawdown, if you will, folks, from the strong dollar moment that Kit Jukes nailed. He nailed that call. Does this signal today a renewed confidence in you of a weaker dollar?
No, yes, I'm still confident. Look, the dollar reached levels it hadn't seen since 1985. If you'd asked me in 95, 05, 15 whether we'd get back to 1985 levels, I'd have said, we're not going to do Star Wars, Reagan, Volcker again. It's not going to happen. So it's coming from a great height. I think it's got further to fall. I think February is where we're supposed to pause. The big things that drove it, the peak in long-term real interest rates in the United States, the good news in Europe on the energy crisis, the Japanese pivot, and the China reopening, they're all sort of in the price. So we're sitting here waiting saying, what's the next big dollar driver from here? And I'm not sure that yesterday's FOMC was. So I think it's going to pause for February and then weaken again after that.
How will the tone of the ECB press conference and the ECB statement differ from what we saw from the Bank of England and even more extremely from the Federal Reserve yesterday?
I think it's bound to be hawkish, focused on inflation. The ECB has an inflation mandate, and I think is likely to reinforce that pretty clearly. They are still worried about inflation at this point in time. They think they need the economy to slow. They think they need the labor market to ease up. They don't have as weak an economy as the UK, and they do have an inflation problem that's not quite as big, but is bigger than the ECB can cope with. So I think it's going to be pretty straightforwardly hawkish coming from Christine Lagarde without too much messing around, laying out the details or more details of the plans for quantitative tightening, things like that. This is a central bank with a rule book run by a French lawyer with a reputation who obeys rules, and that'll get them focused on that. So I expect them to be chief hawks.
The Jukesian snark there was legendary.
We'll hear from the lawyer in about 95 minutes. Looking forward to that. Can we speak about this lawyer, Chairman Powell? He's going to be interviewed by David Rubenstein at the Economic Club of Washington next week. Just to finish on this, what do you expect to hear from him?
Some pushback on that interpretation of what I think he was probably felt pushed in the press conference about various things people had said. his defense was to say, you'll see our new forecasts next month because we don't have any. We don't have a new dot plot. This is where we are. And I think he has a chance to prep himself to try to talk the market back a little bit to where the dot plot was, or to talk away the idea that they'll be cutting before Christmas again. But that's the most that's likely.
Hey, Kit, great to catch up with you, as always. Kit Jukes there of SocGen. After the Bank of England hikes interest rates 50 basis points, in about an hour from now, we'll hear from the ECB, also expected to be hiking 50 basis points. In about 15, 16, 17 minutes, you'll hear from Governor Bailey at the Bank of England. We won't take that. We'll be bringing some of the headlines on TV and radio. We will be taking the news conference with President Lagarde, Tom, a little bit later this morning.
Dumb question, oh wise one. Do they dissent at the ECB? Do they have?
So it's a little bit more interesting.
Voted?
It's not as transparent, but you will get a question in the news conference because, as you've pointed out, the ECB journalists do their job, Tom. And in that news conference, they will ask, was this decision today unanimous? And you'll get some clarity as to whether it was. And then a couple of minutes later, and sometimes in the news conference, you'll get a news report from sources saying whether they were happy with the decision or not. So this one plays out a little bit differently in Europe.
Usually those sources say, no, they were really miserable and it was terrible and she didn't reflect it at all. And then the next day she comes out and walks it back as well. So, perhaps we'll see the same playbook there. But I do wonder whether Jay Powell is going to really push back. I think he risks credibility if he comes out and just says, you guys hashed it out, cat's in a bag, go for it.
You've got a decision to make. We've talked about it. Either he wasn't very good at his job yesterday and he messed up and he's got to walk it back, one. As you've said, door number one, and door number two is he doesn't care about financial conditions where you see them as much as you'd like him to or thought he did.
Right.
And that's basically it. From New York, this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Will a slowing economy finally hit the U.S. job market?
The real test for the bear case seems to be jobless claims.
We need wages to come down pretty significantly, and I'm just not sure that's going to happen.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Have we returned to pre-pandemic labor force?
You could see jobs go down to, say, sub 100,000 in the next couple of months.
That'll get their attention on Wall Street. The January Jobs Report, Friday on Bloomberg Television and Radio.
I will try to keep this brief, but I cannot promise there will not be some tears. This is the best job I've ever had. And as I did in 1988, in 2008, and 2020, I look forward to being on your side when you run for president in 2024.
Lisa, you can't laugh at that.
I wasn't the only one
You
laughing.
can't laugh at that.
Well,
I thought he was laughing. I didn't think he was crying. I actually thought he was laughing for a second.
That's the reason why you were laughing. And then when you realized that he was crying, you just started to cry with him.
He was emotional. Stop it.
I was
He
crying
is
too.
so competent that on both sides of the aisle they respect him. Ron Klain, they hate him, they disagree with him, et cetera, but they adore him just because of his policy, competency, and his gentlemanness.
Ron Klain, the outgoing White House Chief of Staff, and let's not bury the lead here. 2024. Shall I read that quote again? As I did in 1988, 2008, and 2020, I look forward to being on your side when you run for president in 2024. When, not if. When.
Come on, can you really read that much into it, or is this just sort of like a collegial?
Second time he's done it.
Or is this like
but
this is like a collegial, like I'm going to support you to the end, no matter what. You are going to be the leader, kind of, you know.
John loves our never-ending campaigns because over in Britain it's like 8 days. You know.
And then another 8 days right after.
Yeah, we're going to switch gears here with Amory Horton, and we're going to take a spin off of an important article in the Washington Post today, which talks about the European dream for Ukraine. It's a really, really important idea about how the continent deals with year 2 of Ukraine. Amory Horton joins us right now, our Washington correspondent. Amory, I'm going to cut to the chase. I guess there's an American dream out there for Ukraine, for Eastern Europe, et cetera. What is the American dream? I mean, you've been so good on living this in London and here. What is our American dream for Ukraine?
Well, I think the first step really is what the U.S. wants to see is Russia leave the territories they are occupying and illegally annexed from Ukraine. So that would be Luhansk, Donetsk. Overnight, there was some serious shelling and missile attacks. And Crimea is this interesting place because many Russian people really do see Crimea as Russian. But there has been more talk, and there was a New York Times article about a month or two ago that the U.S. is considering and warming up to the idea of Ukrainians attacking Crimea and taking Crimea back. 100%, that is the U.S. dream, Crimea included. But I think the first step really is to make sure they can push Russia back in the worst fighting areas, which is really the eastern parts of Luhansk and Donetsk.
Is our American dream, does it mean thousands of American soldiers across the eastern front of Russia, from Finland through the Baltic states into Germany particularly, and then down to the Black Sea?
Well, this president definitely does not want to send U.S. troops into Ukraine. He's made that pretty clear. Neither do any of the other supporting allies. But obviously, you have seen over the course of the past year, and we're going to be approaching the 1-year mark of Russia's invasion of Ukraine at the end of this month, that they have been bolstering the eastern flank with U.S. Military personnel and armor as well.
Amid the fog of war with Russia and Ukraine, how much focus is there down in Washington, D.C. on what's going on with Iran and Israel, which seems to also be escalating?
Yeah, this is a huge focus for individuals who are following foreign policy, especially since you had Secretary Blinken just in Israel. He also was in the Palestinian territories in Ramallah, meeting with Mr. Aboud as well. This is on the heels of, even this morning, you had Israeli warplanes in Gaza and the Israeli army saying they were going after ammunition plants as well as military depots for Hamas, where they make weapons. But we are off the heels of 1 month of probably one of the deadliest months we've seen between Palestinians and Israelis in years. And Secretary Blinken left officials behind to try to make sure they can restore peace and calm. And this is going to be a major topic today in Washington, because the president will be having lunch and a big discussion with King Abdullah of Jordan. He was here all week. He was up at the Hill thanking lawmakers for the aid they've been sending to Jordan. But obviously for him, paramount is stability in the Middle East.
There's this issue of humanitarian questions around just what this could lead to in terms of devastation. There's also a question around crude, it's particularly with Iran, and there was questions about opening it up to the international market. Now that's a little bit further off the table, given the recent conflict. What are people saying about the potential widening of that conflict and the disruption to crude output, especially on top of what's happening with Russia and Ukraine?
Well, concerns about any instability in the region has to do in the crude market with the Strait of Hormuz, which 20 million barrels of oil go through a day. When it comes to what Iran is doing right now in terms of oil exports, is we do see an uptick. A lot of this happens in the black market, sometimes ship to ship, and these tankers will shut down their tracking. The U.S. administration has made pretty clear that they're going to go after this. So even though they want to see as much oil on the market, they want to make sure that they are crushing Iran when it comes to, they do not want any sort of leeway or any avenue where Iran could be exporting when they should not be. And obviously, most of this crude is ending up in China.
AMH, let's finish up by wrapping up this one. When the outgoing White House Chief of Staff says, I look forward to being by your side when you run for president in 2024, how much weight should we put on that?
I think a lot. He said when, not if. He was just, it's true, when. He said when you run, not if you run. The president hasn't come out and announced it, but Ron Klain has now announced it maybe 2 or 3 times for him.
AMH, thank you down in TC. It is literally 2 or 3 times that he's teed up this run, and the president still hasn't officially announced it. Still early days, TK. I don't think there's massive pressure to make that call just yet. But what if he doesn't? Then it gets really interesting, doesn't it?
I stand corrected. You know, if Anne-Marie and you both put weight on this.
You didn't need me to say. You needed Anne-Marie to say.
I think both of you are correct. It sort of, is he basically saying, come on, get on it. We talked about this. You're known for taking your time with decisions. Let's go. Out with it. The more momentum you can build.
Is there a rush, though? Do you think there's a rush to make this announcement?
There's not a rush when it comes to the actual race. Perhaps there is a bit of a rush when it comes to his political clout within the party in terms of his leadership role in order not to be a lame duck president. And that perhaps is how people are going to view his announcement of a run more than anything else.
Oh, certainly if he's not going to run, he needs to give people time to think about whether they should be running.
But he needs to indicate that he's going to run even if he doesn't plan on it.
TK?
My head's spinning on it.
Yeah.
I just wish we were British. I just wish.
Do it in a week.
We get to May of 2024.
You tried with the pie.
We would try.
I don't think it's going to work. I don't think it's going to work.
Can I bring up a bond issue? We mentioned short covering yesterday. I thought Zero Hedge used Bloomberg nicely yesterday on Lisa, aggregate Treasury futures, net spec positioning. We talk about equity shorts in gloom covered yesterday, but the bond market short position is stunning.
Heading into
way
this,
beyond equities.
Well, heading into this, there were reports that hedge fund short bets on treasuries had reached record highs heading into this. And now it's unclear what they were hedging against, right? It's not necessarily a naked short in that kind of way. However, that really does indicate, John, just what we're looking at in terms of the violent move, and perhaps it's overstating the interpretation of Jay Powell's remarks.
There is one hell of a pain trade emerging in early 2023.
Better said, yeah.
This is so painful for so many people because they came into 23, and we all know the consensus because so many people sat in that chair, came on this program and said it. The first half's going to be dreadful. The second half is going to be all about the recovery, and January's just kicked off, and we've ripped through last month, and it's continued. Everybody expected, I say everybody, 9 out of 10 people we spoke to, all expected Chairman Powell to face off with easy financial conditions and pushback, and he wouldn't even characterize them as easy. That was what was ridiculous about it. And do you know where the clue was? The clue was right before the decision. The former vice chair, Richard Clarida, we asked him how he'd approach it. He just kind of shrugged and said, I think it's a little bit more nuanced.
But Tom, to your point, how much is what we're seeing in terms of price action just a direct relation to the pain trade and not necessarily a true statement?
That's where I am. And bonds, too. I'd emphasize the equity-centric nature here is just too much.
Wei Lee coming up from BlackRock. Looking forward to that conversation from New York. This is Bloomberg.
investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
President Joe Biden delivers the State of the Union address. Join David Weston and Bloomberg's top political reporters and analysts live from the Bloomberg headquarters in Washington, D.C., as President Biden lays out his plans to tackle the war in Ukraine, Congress's debt limit standoff, immigration, and more. And stay tuned after the speech as we break down the Republican response. Special coverage starts at 8:30 p.m. Eastern, simulcast on television and radio, only on Bloomberg, your global business authority.
As of the close yesterday, the scores year to date up 13% on the NASDAQ, on the S&P 500 year to date, as of yesterday, up 7.3%. Just what a rally. And we add to it. We add some weight to it this morning. The NASDAQ 100, helped out by Meta, up by 1.2%. On the S&P 500, up a third of 1%. Lisa's going to run you through the Meta earnings in just a moment. Let's run through the bond market together. 2s, 10s, and 30s look like this. The 2-year yield's lower by a couple of basis points, a break of 4.1% to the downside. Again on a 2-year, did that yesterday too, briefly. On a 10-year, we're down a couple of basis points again, 339. Payroll's coming up tomorrow. Jobless claims a little bit later this morning. The ECB on deck in about 45 minutes, looking for a 50 basis point hike from the ECB after the BOE goes 50 basis points. Euro dollar looks like this, very close to 110. 109.98 on euro dollar, positive a tenth of 1%. For those of you football fans, real football, you know where I'm going with this. You'll understand this joke. This from Luke Cower of UBS, the Bank of England. Chelsea's January transfer window indicative of desperation, not underlying demand for labour. If you've been familiar with Chelsea's transfer spending, Tom, they've spent a fortune over the last month or so.
How did Newcastle come on so well? I mean, I know they beat Southampton. It's not like beating Arsenal, but is that outside money
clearly
boosting?
There's some Saudi money,
Newcastle?
but I will say their strategy in the transfer market has been very different to, say, when Chelsea first got hold of money and when Manchester City first got hold of money.
Right.
They're not throwing hundreds of millions here, there, and everywhere. Todd Bodie at Chelsea, you know him from the LA Dodgers, he's spending serious money. Enzo Fernandez from Argentina, 107 million sterling. Just like that.
I mean, this is important. Lisa's working on earnings, and Whaley is going, why am I here? But Conte's sick with Tottenham. Is that a big deal for the future?
Well, it's
Gallbladder,
clearly a big deal
serious
for him.
illness.
Well, let's hope him the best. When's the operation?
Don't know. Didn't speak to me.
I never thought you and I'd be talking about this, but we are.
No, but there we are. But I mean, I'm like, how do they move forward and compete with Newcastle and the rest of it?
Well, they're going to have to spend a lot of money.
Whaley's got one foot out the door. Let's get going.
Just stay there, Wade, stay there. Stay there. We've got a ton of earnings coming up later. Lisa, we started with Meta yesterday. Then it's the big three a little bit later this afternoon.
Yeah, Alphabet, Amazon, and Apple, all of them are coming out. And intraday, we are seeing the shares gaining on the heels of what we saw yesterday from Meta. I am interested in the underperformance of Apple, which is interesting to me because they haven't performed as well to date as the others. And this possibly is because there was already a lot of froth built in, or I don't want to say froth, but there's already a lot of strength built in there. Those shares up 1%, Amazon shares up more than 4%, Alphabet 4.6%. We talk about Meta. I just want to give some perspective here. Yeah, the shares are climbing, surging in pre-market trading. But since November 3rd, the shares are up more than 70% before even the gains that we're seeing intraday. They could have doubled since their low on November 3rd. Easy come, easy go. What are we even pricing anymore, John? When you take a look at some of these moves, how do you gain what's being priced in and whether it's just all tied to sentiment?
I think at the end of the day, the fears a number of months ago around the direction of this company, because you have to remember the control of one man at Meta. It is one man with a ton of control to spend a ton of money. And there was a fear that he was just going to run away with this.
Okay, but the existential risk of will Instagram be the social platform du jour in 2 years is still there, right? I mean, it's not like they're materially changing their potential prospects. In fact, they're even more hinged to the two platforms that they have. So again, I don't know what we're pricing in here.
Did he identify what the metaverse is?
You're really keyed into this. I think that,
Throwing money at it and trying to figure it out.
I'm like, $40 billion buyback, I can handle that. I'm absolutely baffled by this. To me, it's almost childish. I just don't get it. I mean, I feel foreign.
You want my view on this?
Please, I'm asking.
I think social media has caused so much harm in society. And to then sit here and say that we need to live virtually and that's the future, I find that deeply upsetting. Not to get too serious about it, but I do. This company's been criticized for so many different things. Hurting the psychology of young people.
All right, just briefly before we get
you
to
want to push back against that? Good luck to you.
I'm going to push back against that. Totally agree with that.
Okay,
however,
what's the pushback?
In the spirit of science fiction, in the spirit of exploration of all of the new technologies, there should be a platform to explore the potential for things. The problem is the dominance and the complete, subsuming of all competitors, and also the influence that some of these platforms have. So two different issues, because you want to also encourage some of the innovation there too. That's my 2 cents.
Okay, cool.
We just never have three people brought a show to a stop like we just did. There's a group effort, I might point out. Right now, an important conversation with Wei Li.
You live in Zuckerberg's world. Have fun. I'll take a pass.
Wei Li with us now, Global Chief Investment Strategist at BlackRock, and she knows Lawrence Fink is going to walk back the chairman's comments yesterday. What were you thinking at 2:45 p.m. yesterday? Glued to your Bloomberg and seeing what we saw.
It was quite an incredible day. Yeah. Going into the meeting itself, we thought the focus would be around the disconnect between market pricing in terms of cash paths, future rate cuts, and what the Fed is going to say. But what we ended up having is a disconnect between Jay Powell and himself. Right? In his prepared remarks, he was very clear that they will stay the course until the job is done. Mm-hmm. He was also very clear that parts of the market service inflation, core service inflation, they have yet to see signs of disinflation. But in the unscripted part, the press conference, he then was not clear in pushing back against the financial conditions. And he was also distancing a little bit from the December forecast, but without giving any clue in terms of what he thinks it could be. And that's why markets then just jump.
You have an institutional call of a shorter duration, I'm going to call it somewhat higher yield strategy. We're all conversant in equities and shorting. There seems to be a massive short bet in the bond market as well. Do you worry about a jump condition where you get a bond short cover and you get price up as a general statement and yield shockingly lower? Is that part of your probabilistic structure?
I think what we have seen so far this year is everything rally, right? So John talked about equity rally, but it has been an incredible rally in bond market as well. And part of that was driven precisely, as you said, Tom, this short covering, short squeeze, and also this fear of missing out. So think about everybody finishing 2020 deeply traumatic year across equities and bonds. And start of 2023, sentiment seems to be taking a turn, and people just wants to jump in without kind of assessing how much of the damage is being priced in, which at this juncture, none of the damage is being priced in. People are talking about, is it going to be recession? Is it going to be soft landing? Markets are pricing in take off from here. We're not talking about landing anything. So, it's a huge amount of animal spirit boosted by cash being deployed into the market, and this is the momentum that we're seeing.
If Jay Powell doesn't push back against this market, as he did not yesterday, what's going to trigger some sort of reversal in what we're seeing right now?
I think when it becomes clear that parts of the inflation complex is still persistent, is still sticky. So specifically, we're talking about core service X shelter, right? Like, yes, goods service rotation leading to goods disinflation. That is a trend that has been many months in the making. Shelter, expecting that to come down over time as well. But service, core service X shelter, very linked to wage dynamics as well. Labor market is still very, very tight. And I think the jury is still out there that we can be comfortable and complacent that inflation is on the way down, all the way to target.
What's your conviction level? I mean, is this the time to lean heavily against the tech rally, to basically sell everything, cash out, and just hide out in cash until you start to see that downfall?
I think this is the time to stay invested. Right now, we don't want to chase the tech rally just because of the incredible momentum that you yourself described as well. And more broadly, looking at what developed market equities are pricing, very, very positive outcome is priced for perfection. It's hard for us to chase that. But we have had a preference for emerging markets that have been doing really well on a year-to-date basis. We have had a preference for short duration bonds and IG credit and mortgage agency backed mortgages, and all of that have been holding up okay as well. We're talking about an everything rally, so staying invested is important.
Wait, just to finish on the Federal Reserve, if we can. We talked a long time about the end of the Fed put, the introduction of a Fed call. Did that get done away with yesterday in that news conference?
Well, he was not very consistent within himself. So I think markets are reading into it what it wants to read into it, which is to jump and kind of build momentum and chase this rally. So I think it's too early to say, do we have a Fed put turning into a Fed call, turning back into a Fed put? We don't have a very consistent Fed at this moment.
We'll hear from Chairman Powell next week. And Tom, the question's still being asked. Is there a cleanup act that needs to be done?
Yes, and I think it's. I have to admit, as I said, I may actually read the minutes, and all of a sudden these speeches, particularly from the vice chairman, from Brainerd. I'm sorry, and Whaley nailed it in her first response. This idea of there were two Powells there yesterday. That's accurate.
When you're that hesitant about asking a very direct question about whether you discussed a pause or not, largely implies they probably discussed a pause.
Of course they did.
Why the hesitancy?
Because he didn't want the outcome that he got anyway, right? I mean, this is the issue, is that this is the reason why perhaps he's going to push back. Because if he did have conviction in being able to be fully transparent, didn't want to send a different message, why not just say, yeah, we talked about it, we talked about everything.
We can find out in the minutes anyway.
Exactly. He was like, read the minutes, go away.
One Fed official that brings it up in the next couple of weeks. We talked about this. The closer you get to say 5%, and we are getting closer. If you just look at the range of the dots in the dot plot from the summary of economic projections at the last meeting, not this one, the one before, it pretty much tells you we're getting to that point where a couple of individuals are going to say enough's enough. And other individuals, I think Neil Kashkari's out there and he's a voter this year, Tom, who said, I want to go to 540. So that dissent's coming one way or the other unless the data changes convincingly in one direction.
And to his credit, Powell circled back routinely to an ex post strategy by a central bank, which is not an original thought. That's the way it works. John, can you translate for me?
Sure, what you need.
May of 1940, Churchill.
Okay.
It is victory. Victory at all costs. Victory in spite of all terror. Victory. The British love the word victory. And the governor's channeling it this morning. Churchill had a most serious time for the nation. But
is this your effort to be British?
No, I can't be British. You know, Pharaoh's he says once Pharaoh just said,
he was
give up.
Growling earlier.
Yeah,
but
Churchill.
You're growling. Lisa wants me in the metaverse. I don't know what's going on this morning.
John, Bailey says too early to declare victory over inflation.
But it is. I think Chairman Powell basically said the same thing. You're definitely going to hear the same thing from President Lagarde in an hour from now.
I have to admit, it's not going to be a snooze fest.
Let's not go there. Wait, can I just say thank you?
Thank you so much.
Thank you for tolerating us.
Yes, we're going to, from now on, after every Fed meeting, Whaley.
She's like, absolutely not.
I love that. I love that.
Bring Larry Fink next time.
Coming up.
I would take that.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Markets rallied after the Fed raised interest rates by a quarter point. That despite Fed Chair Jerome Powell warning that further rate hikes lie ahead. Still, he acknowledged that the U.S. economy is in an era of disinflation, price pressures cooling. North Korea has shut the door on talks with the U.S. over its nuclear arsenal. Kim Jong-un's foreign ministry also pledged to respond to what it sees as threats from the U.S. After firing off a record number of ballistic missiles last year, North Korea has been relatively quiet to start 2023. It's only tested one missile so far. Aides to President Biden and India's Prime Minister Narendra Modi are discussing a possible state visit to Washington this year. So far, the president has only hosted France's Emmanuel Macron for a state visit. The U.S. and India are working to share advanced defense and computing technology. Israeli warplanes bombed parts of the Gaza Strip early today. Officials described the targets as a chemical plant and a weapons manufacturing site for Hamas, which Israel describes as a terrorist organization. That comes after a month of bloody clashes between Israelis and Palestinians. And shares of Carvana are on the rise as the used car dealer is on course for its sixth session of straight gains. It comes amid a rally in riskier assets following signs from the Fed that inflation is easing. Shares are set to hit their highest level in over 3 months. They're up 186% this year. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody's talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
They're feeling their way along. They're in a new phase in many respects. Now they believe they are going truly meeting by meeting, and they probably need a little bit more restrictive stance of policy. And in March, we'll learn a lot. We'll learn a lot about how they actually see this play ending.
We've got to wait until March. That was Dennis Lockhart, the former Fed Atlanta president. Equity futures right now, Tom, are positive about 0.4% on the S&P 500. Let's work through the price action. In your bond market, yields lower by 4 or 5 basis points. On a 10-year, 337.26. Euro dollar totally unchanged, 109.85. But how to look at 110 going into the ECB? The ECB about 30 minutes away. We're looking for 50 basis points. And if you remember how December went, we had one of those news conferences with Chairman Powell where we were like, is that it? Let's move on. And then President Lagarde came out and sent everything lower. So look out ECB a little bit later. HSBC making that point a little bit earlier this morning. I'll bring up their quote from their team. With the February Fed event risk now gone, it might be tempting to go all in on equities and other risk assets. But beware, the potentially bigger hawk, the ECB, Tom, is lurking just around the corner.
It is, and I want to say within the central bank overlay, and I'm not kidding, folks. I'm actually really enthused by how Christine Lagarde handles this moment she has this morning. But John, I'm looking at NASDAQ 100 up 1.4%. I'm looking at the chart, literally the chart that got me hired at Bloomberg. We're not allowed to show it on TV. It's too much information, and it's on a classified need-to-know basis. But John, I'm looking at the NASDAQ 100, which is called log convex, on a 3-day chart. There is an acceleration to this, which is tangible. You can see it on the screen.
I will say there's a meta factor in there too, Tom. The fact that Meta's up 19% in the pre-market, helping out the NASDAQ just a little bit.
What about this afternoon?
It's a big afternoon, Lisa, for earnings later.
I would agree, and I wonder how much you get that ongoing loosening of financial conditions. The frustration that I feel in the notes parsing the speak yesterday is really telling. So this is Andrew Hollenhorst coming out basically saying Chair Powell followed the recent run of optimistic Fed speak and failed to significantly push back on looser financial conditions, which led to further loosening.
Okay.
And then basically said, we're pushing back against this narrative that we're going to get this perfect landing, everything's going to be great, because we're going to get a hot jobs report and everything's going to be back on track in terms of inflation still running very high.
I mean, we're among friends here. I mean, good morning, everyone on radio and TV. I had a beverage of my choice in my hands after our 18-hour day yesterday.
Okay.
And what am I thinking about? Can you imagine the conversation of Mike Wilson and Ellen Zentner at Morgan Stanley? Zentner publishes today, 4 3/4, wherever she is, below the Hollenhorst line, below Anna Wong. Mike Wilson's got to re-justify a cautious stance, I guess is how I would put it. That must have been a hell of a conversation.
Look, I caught up with him yesterday. 1, don't fight the Fed was the message. Yes, It was in the notes.
Swag 101.
It's there, his words. But ultimately, too, his call is bad earnings, and the earnings haven't been great. The question I've asked, and I've spoken to Mike about this, I asked him yesterday, Mike, you can learn something from the incoming information. You can also learn something about the way the market responds to that incoming information, and this market is rallying. And he took note of that, but ultimately he thinks over the next couple of quarters, you're going to get a drip feed of this, just bad earnings, and we're going to bump into some weak data. And Mislav Matejka over at JP Morgan alongside Marko Kolanovic, basically saying the same thing. You're going to hit an air pocket of weak data in the next couple of quarters. It's coming, which is why the bears, as they stand, this is incredibly painful. And if you're in this market and you're trying to short it, that's incredibly expensive. This hurts. This hurts, but the call still stands for them. The weak data's coming.
But putting together what you both have talked about, a short squeeze and the fully painful, the maximum pain of January, you put that together, is this the great flush in the opposite direction before people start to really understand the earnings and what we're seeing that perhaps challenges some of the risks?
I'm data dependent, and I'm going to go with Julian Emanuel and Ed Hyman, where they're modeling out 3% inflation. Maybe it's 3.5. I'll let Mr. Hyman tell me what the response is there, but the answer is there's a disinflation tone in check. Maybe not in oil, where China and the Pacific Rim may come out of a very difficult COVID environment, and there's some modeling of higher oil prices yet to occur. 82.19 on Brent crude. We speak to head of all of our hydrocarbon efforts and commodities. Will Kennedy joins us now from London. Will, there's a feverish tone in the United States about profits of oil companies and windfall profits and the rest of it. If they're minting money now at $80 a barrel, how much are they going to mint at $110 a barrel?
Well, that's going to be good for their profits, obviously, Tom, but I would point out that a lot of this year's profits have been based on natural gas prices, especially Shell that we saw today, where they clearly made an enormous amount of money from selling their LNG portfolio into Europe. And gas prices are markedly lower, especially in the United States, where they've fallen right back to 2. So, yes, a bullish outlook for oil will be good for energy companies, and we expect them to keep making a lot of money. But I would just urge people to think about the gas side of the equation as well.
You have a terrific perspective of our reporters in North America and our reporters in Europe. On the debate of profitability, what is the major divide or distinction of the governments of Europe, regulation of Europe, if you will, and of the United States?
Well, clearly in Europe, we've had windfall taxes, and in the US, there's been some discussion of windfall taxes, but they're unlikely, I believe, for political reasons to ever get off the ground. So that's a big difference. And I think there's a big difference in strategy, which is partly political, between Europe and the US. And this is really interesting right now. In the US, there's been little investment by the big companies, Chevron and Exxon, in new energy. They've concentrated on making it money and giving it back to shareholders. In the case of Chevron, this enormous $75 billion share buyback. In Europe, they tried to walk a path of doing some of that and some investing in new energy, and it hasn't proved as popular. I think the American model is winning here. If we look at the returns for investors on Chevron and Exxon far outstrip returns for Shell. And the noises from the new Shell leadership, they got a new CEO, is that they're going to focus on those returns, which means giving more money back to shareholders and less focus on the energy transition, which obviously has more political purchase in Europe than some parts of the United States. So in that regard, I think the US energy companies are winning the political argument.
Why are prices still falling on crude?
Well, I think that we should probably be looking there at the amount of oil that is coming from Russia. Russia continues to do a very good job of exporting a huge amount of its crude oil. They're finding customers in India and China, albeit at discounted prices. But if we look at overall Russian crude production, it's still close to 11 million barrels a day, pretty much what it was before the war. And I think people continue to be supplied on the upside by Russian production, Russian exports. And as long as that continues at that pace, the market may remain a little bit soft.
Will that offset, will any kind of reopening from China and perhaps dampen that inflationary impulse?
I mean, it seems to be for the time being. How long that lasts, I don't know. If we get into the summer and demand for crude tends to rise and what we call the driving season in the US, and refining margins suggest that there is demand for fuel around the world, and eventually that will start to draw in more crude. So perhaps, but not clear yet, I would say.
Hey, Will, thank you. As always, Will Kennedy there of Bloomberg on the energy situation. We are about 20 minutes away from the ECB decision. Christine Lagarde will deliver that at about 8:15 Eastern time. 30 minutes after that, you get a news conference with the ECB president, Tom. Are we looking for another hawkish turn from the ECB chief after what she delivered back in December?
She's not going to declare victory. I know that for certain, as Governor Bailey was alluding to as well. John, you've got real first-order experience with this as well. Explain the body language right now that is, someone mentioned the lawyer from Paris. Explain the body language that she has to straddle between, say, the core of Europe, the Netherlands, the Bundesbank, and others that are saying, be a little kinder.
We have a really different backdrop. So if you think about the battle that, let's say, President Draghi had to have with the core of Europe, with the Bundesbank, it was because inflation was just way too low. Inflation's too high. It's a single mandate central bank. Tom, is pretty clear what they've got to do. They've got to get interest rates up, financial conditions tight, and inflation lower at a time where I think finally, for the first time in a long time, they're actually concerned about a tight labour market in a way, just relatively speaking, they haven't been before. So, Tom, if that's the case, guess what? You're not fighting the core of Europe. In fact, after that news conference in December, I had the feeling many other people did too. That was like the Bundesbank meeting over in Frankfurt, Germany, at ECB headquarters. They are in the driving seat, Tom, big time.
Yeah, well, and again, that's the divide there in the politics. And let's remind everyone, they do not have a fiscal policy to play off of. I mean, Blanchard's new book is entirely fiscal, linking it into monetary. I don't think you can do that in Europe.
So we touched on the China issue yesterday around the Federal Reserve, far more pertinent for the ECB. I hope that comes up in the news conference. How are they thinking about China reopening, what it means for growth, and what it means for inflation?
And we are hearing about that a bit from Bailey as well, talking about external pressures easing, even as domestic pressures firm up.
Jeff Yu of BNY Mellon coming up. Looking forward to that conversation. Your ECB rate decision about 15 minutes away.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning, and therefore the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return. And to get a long-term return, putting it into private hands is one way of doing it. But really, the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is US public sector owned that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
The top names in global leadership are on Bloomberg.
I very much support the idea of a stronger sovereign geopolitical European Union. Democracies should cooperate and that they should understand that there is something we have in common, respect for the individual rights of man, being in favor of the rule of law.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
We continue to anticipate that ongoing increases will be appropriate.
This is a Fed that really has been pushing back, particularly on the easing of financial market conditions.
What the markets heard was this issue of the conflict between financial conditions easing and whether or not that would impact the Fed's policymaking.
If price inflation continues to come down as it has, it does open up a greater path to a soft landing.
People forget that you can have a recession, and while it's going on, you don't know you're in it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. It's a 24, 30-hour marathon of huge information flow. In this hour and 15 minutes, John Farrow on the ECB with his decades of experience on the lawn in Frankfurt and the 3-hour lunch afterwards.
Is that how
That's what it's like, right?
30 years at the ECB covering Frankfurt, Germany. Tom, yeah, it's important. 50 basis points. They're set to go again. We had that guidance from President Lagarde back in December that this will keep going. We had a bit of pushback in a couple of stories, Tom, and maybe some Fed officials, some ECB officials rather, unhappy with the trajectory of things. But ultimately, CPI is still too high. Inflation's too elevated. The ECB has more work to do. What's interesting about today, and this is just a small point, a footnote maybe, we didn't get German CPI this week. It got delayed by a week, and we had this downside surprise on Eurozone inflation. So maybe we'll get some comments on that.
On a broader thing, and I want to go to a wonderful Goldman Sachs angle in a minute. Stay with us, Global Wall Street. This will be fun. But, John, we're going full circle here back to another time. I mean, the governor of the Bank of England is saying we can't declare victory. We're going back to a time when money costs something.
Discipline's
There was
back.
inflation. Discipline is back. What, the gravity's back, as Taleb says.
Why have you got Mark Zuckerberg going out there right now saying it's the year of efficiency? It's the year of efficiency because it's the year of 4% interest rates. And Lisa, maybe 5.
Well, yeah, this is exactly it. So you're going to see this sort of rationalization and layoffs in certain companies that have been built up over the longer period. However, the long and cumulative lags, remember that? We're not talking about that anymore.
Right.
It's just basically we're done. And perhaps people are saying, okay, it's not a victory lap. We're not done. That's what Jay Powell was saying, but that's not what he was doing. He was kind of indicating, we're kind of getting into this good disinflationary place.
We've got huge news flow this morning, really, right through the morning. ECB, the Lagarde press conference will be important. Even I'm saying that. And then we go on to the earnings soiree. And John, as I mentioned, we come full circle. Can we go back to 1981?
Would you like to do that now?
I was knee-deep studying the commodity world of Will Kennedy, who we just had on, and Goldman Sachs went out because Salomon Brothers was big in commodities, and they bought J. Aron, and they bought into it from J. Aron a guy named Blankfein. And commodities now are coming full circle. Bloomberg reports this morning, Srinath Rajan and his team, that they made $3 billion large revenue in commodities this year. And I'm sorry, like the rate market, like China reopening, I feel very full circle this morning.
That unit recorded the biggest revenue gain since at least 2009, according to Sri and Jack Farchi's
They should
reporting.
bring Blankfein back. I mean,
Hey, don't start rumours. Don't start rumours. But Tom, let's tie some stories together. The energy story was massive in the last 12 months. I don't think it's over. It's not over. Let's be clear about that. It really isn't. Look at the war in Ukraine, Tom. Look at the war in Ukraine. The uncertainty isn't over. Let me be more specific. The uncertainty around that war is not over and what it means for Europe. And if there's a central bank right now, Tom, that still faces some difficulty, it is arguably the ECB. You've got this war in Ukraine on the one side, China reopening on the other. I've got no idea what the data is going to look like, Lisa, in the next 12 months.
Traders often do well in volatile times. Are we entering a new, more volatile time with the Fed and the ECB and the Bank of England not clamping down on volatility to the same degree? How do you rearrange that? And that, to me, is really the highlight from what we saw yesterday from the Fed press conference. We are entering an era where they're not trying to control the market in the same way that they used to. And this is one of price discovery and is one of prices really
Exactly.
swinging.
If it is price discovery and we clear the markets, as Torsten Slok of Apollo writes this morning, do we get clarity? Maybe we got that yesterday from Powell. I'll let John decide. We get clarity.
I'll get to decide.
And then do we get a new lesser volatility once we clear ourselves out of these pandemic volatile times?
I don't think he wanted to commit to anything yesterday. He certainly didn't even want to commit to the dot plot or the projections of the December meeting. We've got some data to come over the next couple of months, and when we reconvene on the FOMC in March, Tom, towards the back end of March, we'll get some new forecasts. If there is a bias that exists right now, though, I think there is a belief that when we get those forecasts, that dot plot might come in a little bit, GDP might get pushed higher a little bit, and things start to go in that direction. I keep going back to what Don Constant said to us yesterday over at Mizuho. Just by definition, if it's a hard landing, at first it will look like a soft one. This takes time to play out. The one last bastion of the economic data is the labour market. It's always the labour market. It's a lagging indicator.
Yes.
Claims you can make the argument it's coincidental indicator, a coincidental, I get all that, that's fine, and it's super, super low. But look at the ISM, that doesn't look like things are very good right now. It's starting to spread to services, and we'll see how this trend develops in the next couple of months. So if you're the chairman, I think from that standpoint, did the right thing. Hard to commit to anything right now, given where we're at.
Quick data check to get to our wonderful guest, Jeffrey Yu. John, I'm looking at the real yield, the 10-year real yield. Do we begin to think about a sub 1% 10-year real yield? 1.12%, a lower inflation-adjusted yield.
A nominal yield 3.39 on a 10-year, down a couple of basis points. Euro dollar unchanged going into the ECB, Tom, 109.89. And equity futures just a lift once again, up 0.5% on the S&P.
He can synthesize the moment. Jeffrey Yu joins us now, senior market strategist at BNY Mellon. Jeffrey, give us the sum of all these Fed, BOE, and ECB parts. What's the distillate that you will write about come Friday or into Monday?
Well, I still think it's about the real rates situation, Tom. You were mentioning the cost of money in terms of corporates, but that's a nominal cost right now. We need to look at the real cost. If you deflate everything, if you deflate rates right now by wage gains, by the problems in the labor market, still argue, conditions are relatively loose, right? You can make a case for actually increasing capex, increasing credit, especially anticipating the Chinese demand coming through. So I think all in all, central banks will have a case that maybe things are looking to turn the corner. The financial conditions are not where they want them to be, and markets should take notice. No one's pivoting anytime soon.
Jeff, let's pick up on that. The chairman didn't exactly say financial conditions aren't where they want them to be. What did you make of that?
Well, again, it's really where do you think on a forward-looking basis, can financial conditions glide us to a place where growth is going to start to soften in a way that pressures inflation, right? It's a dynamic process. You only find out where you want to be after you get there, right? So I know a lot of it, you can't prove the counterfactual, but at this point, do they have enough confidence that conditions are restrictive enough, not just in the US, but globally, with the glut of excess liquidity? You calculate excess liquidity against GDP ratios, still at record highs. Even in the US, where the decline has been quite strong, we're only down by a few percentage points of nominal GDP. ECB, for all the hawkish talk, they haven't even started yet, right? So by that measure alone, there's potential for loose financial conditions, and that's what they need to be wary of. But at least the path is in the right place.
Well, Jeff, let's talk about the path and the long and variable lags that no one seems to be talking about, or at least focusing on right now. When will we see the brunt of the actions that all of the central banks globally have taken?
Right, then the proof is, I would say, in when they expect that base effect to come in, as Governor Bailey highlighted about half an hour ago. There's going to be an accelerated decline in inflation in the second half of the year when those base effects that we saw last year start to roll off. And if those figures, when they start to come in, surprise them to the downside, I think it will be after the fact that they'll realize maybe they have done enough or maybe they've done too much, and then they can pivot as quickly as possible. But until then, they need to retain the optionality. Going back to what Governor Bailey said, risks have never been so skewed to the upside in terms of inflation. So when you have those kind of upside risk skew, then you cannot afford to say, we can pivot now, we are in a place where we want to be. So I think it's retaining that optionality, and the moment they can confirm that things are in line with expectations, or the target, or going back to inflation targets is clear, then they can move immediately.
We saw a pretty violent move, a pain trade move up for equities, down for bond yields in the first month of 2023. What aspect of this would you push back against?
Well, firstly, one reason why you are seeing this pain trade towards risk, and there's a lot of cash on the sidelines. If you look at our own iFlow custody data, for example, last year was a record outflow year for emerging markets, and so now people are going back into emerging markets. We're seeing plenty of buying in Turkey, for example, and other areas. If you look at the ICI data, $500 billion worth of outflows in mutual funds. You can go back, but you need to be selective. Where we would push back is anticipating that the sectors that have done well over the last 2 years, they are going to continue to do well. Now, in fairness, we are seeing better performance in our flow data, so in emerging market, especially Asia Pacific, selective high yield areas relating to sovereign debt. So people are being selective, but we need to be cautious about the symmetry. There is not going to be symmetry. What worked in 2020, 2021, risk up is not going to work this time around.
Jeff, I want to squeeze one more in. This comes from Hyperconvexity ad on Twitter. It's actually a really good point, and I'd love your thoughts on it because you've touched on some elements of this. You guys are talking about earnings and valuations. The story is in positioning and flows. How would you respond to that?
Well, that is absolutely right. I'm an FX guy, as you know. I look at euro positioning based on our iFlow data at a 20-year high right now. So let's listen to Madame Lagarde. But it would take a monumental hawkish outcome for us to look at our flow and positioning data to say you want to add to euros at these levels. It's overstretched. The comeback, from September levels has been a bit too violent. Valuation's not as attractive yet. So I think right now the euro is going to be on defensive, for the rest of the quarter.
Hey, Jeff, wonderful. As always, Jeff, you there, FBNY Mellon, euro dollar earlier on, higher the session, 110.33. Yeah. It's back down, Tom, to about 109.92, 4 minutes away from that decision.
The pulse of the screen, now it's not like it was yesterday. Yesterday, the short cover was absolutely stunning. But even with Meta, I'm sorry, there's a lift. I mean, SPX is up 0.5%, NASDAQ 100 with Meta up 1.4. But Meta's not a Dow stock, is it? I don't think so. Up 1.4% as well. But there's something going, there's an undercurrent here going on, linking together equities, bonds, currencies, and dare I say, even commodities. I mean, we don't have the oil lift that maybe we'll get.
It's what we didn't get yesterday. We just didn't get that pushback at all. We didn't get that pushback.
I strongly agree with that.
At all. Steve Englander this week, a Stan Chart, said they're looking for that pause in March. Ellen Zettner of Morgan Stanley now looking for that pause in March. I wonder how big that club grows. as we get more data going into that decision.
Did you talk about the pause? Read the minutes.
I saw someone clip that at you yesterday and put that out on Twitter, and it got so much love. And it was so true. That was like the 10-second summary of the Fed decision. Did you miss it?
Yeah.
That was it.
Literally the entirety of it.
That was it. Ibrahim Rakbari coming up, the ECB.
He won't pause.
Moments away.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Bank of England has raised interest rates another 0.5 of 1 percentage point. The central bank said that there would be further tightening if inflation persists. Policymakers also see a shorter, shallower recession than they did in November. Meanwhile, we'll hear from the European Central Bank in just a few minutes. It was one of the biggest hauls ever for commodity traders at Goldman Sachs. Bloomberg's learned that they brought in more than $3 billion in revenue last year. The unit emerged as a key profit engine at a time when Goldman's net income was cut in half to $10.8 billion. Ukraine fears that a new Russian offensive is underway. According to the New York Times, Russia's assembling hundreds of thousands of troops in Ukraine. It's also stepped up artillery attacks. All this comes at a time when Ukrainian forces are waiting to receive tanks and other weapon systems from the U.S. and European allies. Israeli warplanes bombed parts of the Gaza Strip early today. Officials describe the targets as a chemical plant and a weapons manufacturing site for Hamas, which Israel describes as a terrorist organization. That comes after a month of bloody clashes between Israelis and Palestinians. And the U.S. has won expanded access to more military bases in the Philippines. Defense Secretary Lloyd Austin called it a really big deal after visiting military bases and meeting his Philippine counterpart. It will clear the way for a greater American presence in the region as tensions with China persist. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
They're not cutting rates anytime soon, and they're still doing QT. And sometimes it's just passing of these events. People realize, oh, I guess there really wasn't any new information in there that should change my view on stocks, which should be based on the following, that earnings are disappointing everywhere, okay? This is one of the worst streaks in earnings we've seen in quite a while.
That was Mike Wilson of Morgan Stanley, live from New York City, moments away from an ECB decision, about 30 seconds away. Sometimes you get a drip feed. It takes a while, so sit tight. We're looking for a 50 basis point hike from the ECB. Going into it, equities look like this. Positive, Tom, by 0.6%. The euro had a look at 110 earlier on in the session. Since then, Tom, backed away just a little bit.
We'll get the headlines, but Mike Wilson's dead on. We're giving Meta and Tech the love. You know what, John? Honeywell and the rest of them a little soggy, to say the least.
Mike said the earnings were terrible. He compared the investor reaction to a tornado going through your house, a surprise tornado, and waking up and saying, oh, good, it's only the best room that got destroyed.
Well, there's this feeling that some people are saying it's actually better than expected, and yet here we go.
Here we go, 50 basis points from the ECB. The main refinancing rate goes from 250 to 3%. The marginal lending facility goes from 275 to 325, and the depot rate goes from 2% to 250. I have to say, I never thought we'd get here, but here we are. 250, and we break back through 110 on euro dollar. The headlines are going to keep coming out. Lisa, you go through them. I'm going to bring up the statement, and we'll work through this together.
Yeah, I'm looking right now at a meeting-to-meeting approach to further rate decisions. I'm also, I find it interesting that they talk about continuing to roll off the APP portfolio. It's starting to fall from March, so we'll have to dig into what they say about balance sheet types of action. Also saying that rates still have to rise significantly and at a steady pace. This is the hawkish kind of tilt that people were looking for, even as they reiterate some of the other rhetoric from the last meeting.
So here's the statement for you. The Governing Council will stay the course in raising interest rates significantly at a steady pace and in keeping them at levels that are sufficiently restrictive to ensure a timely return to inflation to its 2% term target. Accordingly, the Governing Council today decided to raise the three key ECB interest rates by 50 basis points and expects to raise them further. In view of the underlying inflation pressures, the Governing Council intends to raise interest rates by another 50 basis points at its next monetary policy meeting in March, and it will then evaluate the subsequent path of its monetary policy. So never mind the end of forward guidance, that's basically a commitment to go 50 basis points in March. They go on to say keeping interest rates at restrictive levels will over time reduce inflation by dampening demand and will also guard against the risk of a persistent upward shift in inflation expectations. In any event, the Governing Council's future policy rate decisions will continue to be data dependent and follow a meeting-by-meeting approach. Apparently, just not the March meeting, because that'll be 50,
That's already 50.
But everything after that is meeting by meeting.
I wonder how much guidance they got from Fed Chair Jay Powell. Basically, if you want to be hawkish, you've got to give specifics and you've got to push back. Basically saying, don't even pretend that we're going to step down. We're not stepping down. Let's go. And how much is this basically the guidance that they're giving to really shake the market into acquiescence?
Let's work through the price action off the back of it. Looking at German bund yields, lower at the front end by 7 basis points, 257 on a 10-year. We're lower by about 10 or 11 basis points. Bear in mind that yesterday we had a big rally in the bond market in treasuries too. But yields lower in Germany, and they stay lower. Looking at the FX market, euro dollar, where are we? We can bring that up quickly for you. Euro dollar pushing through 110 earlier and then backing away at 109.95. So it's over you, President Lagarde, Tom, in about, what, 30 minutes' time?
As you look at the yields come in, Italy yields came in as well. I don't want to make too much about it. It's sort of range bound, but the spread, Italy as compared to Germany, comes in a little bit as well. But it's the same thing as we saw with Powell. It's a lower rate regime, and I would translate that as price up is more important than the yield down. This is a price, money moving in, buying into the paper because of a trend that's out there.
I don't understand this.
Which bit?
This is unabashedly pretty hawkish, basically saying we're going to raise rates for another 50 basis points, 2 meetings, 100 basis point increase after people said that they were never going to get off zero or even negative. And you have bonds rallying, yields lower, and you have pretty muted moves. I'm just trying to wrap my head around what the positioning was heading into this, if this is viewed as dovish.
Yeah, I'm going to go to the math of adverbs, and it's significantly Thursday. It's definitely what this is. We got significantly at the Bank of England. We got significantly, and that means the rate of change. I mean, that to me is central bank talk for some form of rate of change up. We're on a vector. We're going to stay on the vector. And again, the data, and you're going to watch all that. But significantly is not an unimportant word here.
No, look, they're going to go 50, and then we'll see. And I think it's the we'll see that the market's picking up on. I don't want to define this statement by what happens in that market because this can all change in this news conference. I always say that. But it's 50, and 50 is what we expected at the next meeting as well.
Okay, I understand that. And actually, one viewer writes in, why not just do the extra 50 basis point rate hike right now?
I'm with them.
So there is this question, and yet at the same time, is this just a market that wants to feel dovish no matter what the central banks say?
I do find it funny when they come out and say it's meeting by meeting, it's data dependent, but that meeting in March, we go 50 basis points. Maria Tadeo joins us now out of Frankfurt. Maria, what do you make of this one?
Well, my question is a question to you. I've been standing here in the cold, in the rain, and everything has been revealed in the statement. 50 basis points. It was super baked in. Everyone knew they were going to hike 50 basis points today. The only question, the thing that made this interesting was, would we get Madame Lagarde saying, I'm not going to pivot and go hard in March? And it has been revealed in the statement. So essentially, I spent 10 hours in the cold, for everything to be revealed very quickly here. 50 today, 50 in March. And then the other thing, again, they also say after that is data dependent, which again is what the market was expecting. After that, probably downshift to 25 basis points. Maybe she even says that, but my work here in many ways is done today, guys.
Maria, they're doing, John, what are they doing? They got a headline here at 3 o'clock Frankfurt time.
I'm going to find a little bit more about the asset purchase program and QT,
I think she's setting herself up for a 3-hour lunch before the QT.
She's so done.
Look, I'm with Maria. Is there any point showing up at the next meeting? They've already agreed to 50 basis points. Maria, after that, can you talk to us a little bit about QT, how the stage is set beyond Q1, Q2?
Well, I mean, remember they had said this was the early QT to appease some of the hawks in the governing council who were saying inflation. Obviously, we have to tackle this head on. That means obviously the hikes, but also drain some of the extra liquidity. She may go into that in the press conference. What I want to know, having said that, in this press conference, is very clear. We're now going back to back 50 basis points. But what is the rationale for it, Jonathan? Because this week we had a string of data, and to me, the best way to describe it is cloudy. We had headline inflation go down, but that's back to energy. Core inflation is sticky. When you look at GDP, the debate on recession is still out. So now what I want to see is the details. But in many ways, guys, this statement, everything is out. I mean, you want to play the press conference, that's great. I can stay late, but everything you need to know is already out.
Hey, Maria, thank you. Maria Tadeo, I'll take the news conference. We'll take the news conference in about 20 minutes' time. Ibrahim Rakbari joins us now, Chief Currency Strategist at Citi. Ibrahim, there's a meeting at the ECB at March 16th. They're telling us they're data dependent. At the same time, they tell us they're going another 50. What do you make of this?
I actually think the March meeting is going to be really interesting for the ECB, and it was Chair Powell that made it that interesting. So when you look at the market reaction today, I think what they're telling us is that string of hawkish central bank meetings is over. And the market was surprised very much yesterday. You saw that in the reaction. And what we're seeing today is telling us in March, we won't be surprised by a similar, I think people call it pivot, by the ECB in March. And I'll be very curious to see what we hear from President Lagarde. But I would strongly advise her to be a bit more like Powell and stop guiding too strongly about intentions from here, because the ECB too has gone a long way. And as your colleague just said, the data actually come in pretty cloudy of late, even in the Eurozone.
Ibrahim, are we coming up with a narrative to fit the flows that are going on in markets right now?
So I do think the price action we've seen since the beginning of the year is very strongly flow-driven. Obviously, a number of things have fallen into place fundamentally too, China reopening, a degree of disinflation, but particularly when it comes to the performance of risk assets, and particularly the riskiest of risk assets, that's really because there is so much cash on the sidelines, and there had been that under-positioning in these assets. So there is a big flow element to the price action we've seen yesterday, but really throughout this year so far.
Ibrahim, what's the dollar going to do on this? We're getting lots of research notes that market's clear, we get clarity, we move on to a lesser volatility. Does that put new legs to an ever weaker dollar?
So we do think that string of dollar weakness has further to go. And we think that's particularly evident still in the areas of the market that benefit from lower rates and lower rates volatility. So that's carry trades, EM, areas that have seen large outflows over the last few years. Within G10 in the currency spectrum, that's probably the yen. In EM, it's the Mexican peso that tends to be most strongly related to US rates. But if you put these things together, it does tell you the dollar probably still has a little bit further to go. But I would also mention, Chair Powell used to say, be humble and nimble. We're still going to be in a very challenging environment this year. So I don't think we're going to see the dollar straight down in a straight line. I think it'll go down from here, and then we'll reevaluate over the next couple of months as that soft landing debate continues.
Ibrahim, this was great. It's just fantastic to catch up with you, and I'm sorry this was so short as we work through the ECB rate decision. Ibrahim Rakbari there of Citigroup. Just to see these two lines in the same statement from the ECB, the Governing Council intends to raise interest rates by another 50 basis points at its next meeting, and then a few lines later, in any event, the Governing Council's future policy rate decisions will continue to be data dependent. I guess what they'll lean on, Tom, is that word intends. We intend to. It will still be data dependent, but no one's going to buy that. This market's just saying 50 and done in March, and then we'll see.
For our American audience, I'm going to cut them some major slack. The Fed enjoys a modernity back to the 50s and William McChesney Martin. The Bank of England does not, John. The ECB certainly does not. This is not their first crisis, but they're making it up as they go. And I would suggest Lagarde is really making it up as she goes.
I would also suggest that markets are making it up as they go, because they're interpreting this as dovish because they see the incoming data as disinflationary. But, you know, other people might say it's kind of neutral. They're just kind of not really taking a strong stance.
Let's wait for the news conference, 20 minutes away with the ECB. Up next, Holder Smeeding of Berenberg. And up next, a little bit of data. We're going to catch up with Mike? I think we are.
Yeah.
Mike McKee down in Washington. Very cool. From New York, equities rallying. That continues. This is Bloomberg.
energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
60 minutes away from the opening bell, equity futures up another 6 or 7 tenths of 1% on the S&P. This rally continues. We add some more weight to it on the Nasdaq, up by more than 1% an hour away from the opening bell. Looking for some economic data in America, looking for jobless claims just seconds away. Going into jobless claims, we just had the ECB hike 50 basis points, the Bank of England as well. And these central banks and this hawkishness starting to look a little bit exhausted. That news conference starts in about 15 minutes with President Lagarde. We'll get to that in a moment with jobless claims and just a wow number and a whole lot more. Here's Mike McKee.
Good morning, John. And the conundrum that is jobless claims continues this morning, as last week only 183,000 were registered. That's down from 186,000, the initial print last week, and significantly lower than what was forecast by the markets. We're looking at continuing claims that are also lower, 1,655,000 last month, 1,675,000. So it doesn't look on the layoff side, on the losing a job side, like the economy is slowing down at all. And it's going to be very interesting to see tomorrow when we get the payrolls report, whether companies are still trying to add or just hoard workers, or whether all of this is pushing up average hourly earnings. Unit labor costs do come down significantly, 2% in the third quarter, 1.1% in the fourth quarter. So that also plays into the Powell narrative that things are getting better. Productivity up 3% after a revised 1.4% in the third quarter. And this is, if you ask an economist about inflation and about the way things could improve, this is the best way, through increased productivity. So you're getting more per worker. And if that holds, then the Fed might indeed be on the way to a soft landing.
Hey, Mike, thank you. I guess the key phrase there, if that holds. Equity futures, they like what they see, up by 0.75% on the S&P. And the bond market, the rally continues on the 2-year. Yields drop by 6 basis points, just about holding on to 4% here at 4.0486%, Tom, on a 2-year.
Can I stir the toxic brew of Washington economics? Did Powell know these numbers?
Well, if he did, then his message makes even less sense. Basically, everyone's saying, look at the data to show disinflation, to show an ongoing weakness. Look at the data, it's really strong.
These are really important numbers, as Mike nailed, and only Mike McKee can do that. Productivity is a stunner with a good revision of 1.4%, and the unit labor cost is frankly more important than claims.
Well, let's get Mike back into it, and hopefully he's still there down in Washington. Mike, how will the Fed think about that 183, and how does it influence your thinking in any way, shape or form about what we might get tomorrow morning on payrolls?
Well, it slightly adds to the idea that the payrolls number may be a little stronger than we anticipated, or at least that the market is anticipating. It's kind of hard to tell because we don't know whether any kind of weakness is because companies aren't hiring anymore because they filled all the jobs, or whether it's because they can't find employees. And we know, for example, the restaurants and bars are still having a lot of trouble finding people. So that's going to be something to tease out tomorrow, but it's the average hourly earnings that are going to matter. Are companies having to pay up more to get people to come to work? I can answer your question, Tom. No, the Fed did not know these numbers in advance.
Oh, come on. It was a good script. Come on, Mike. Go in the store. We're making it up.
Productivity numbers, of course, you know, here at Bloomberg Surveillance, we have the motto, there is no math. But at the Fed, there's a lot of math, and they can parse out the productivity numbers. So I think they probably had a pretty good idea that things looked good on that. But I think overall, it just continues the narrative. Jobless claims aren't that important to the Fed in terms of what their policy is going to be, but it is an indicator that is not flashing red at this point.
Hey, Mike, this was great. Thank you, sir. As always, tremendous coverage from Mike McKee on the Fed yesterday, on the data this morning, and on payrolls tomorrow. That's still to come. Equity futures up 0.7% on the S&P. Talked about that rally in equities, that rally in bonds as well, to see the two-year yield down another 6 basis points. Helped out by the ECB. Maybe, I'm going to throw maybe out there. Yes. There is a wonderful phrase that Steve Englander of Standard Chartered just pinged me this message on the IB on the Bloomberg terminal.
Messages me.
I've asked his permission to share it. He's offered his permission to share it. So here it is. To me, it seems that the FOMC has shifted from unconditional hawkishness to conditional hawkishness. And I think maybe that same phrase applies to the ECB this morning, that they've shifted from unconditional hawkishness to conditional hawkishness. And that is a highly data-dependent approach.
Englander's going all Bayesian on us, and I'm not going to go there because I never really believed in it. But this is important, John. This idea of conditionality means, guess what? They're going to give in and look at the data.
Okay, but they were looking at the data before. Is that justification for markets to rip further, right? I mean, yes, we know that there is some order of disinflation. We know this, and the market is responding to the unit labor costs more than continuing claims or initial jobless claims. Is this enough to indicate incredible strength in earnings that have not delivered?
On conditionality, I would really like to talk to William Dudley right now, the former head of the New York Fed. I would really, really like to know his thoughts on what we've observed from these three banks.
Look, markets, as you know, they care about change. They care about change, and the approach of the central bank has changed. It's, you know, bottom line, that's it. It's changed. Now, ultimately, once you've shifted past that, we can start thinking about the data and all those things. But this Fed has shifted. And I mentioned this a little bit earlier this morning. The Fed has gone from a put to a call, and yesterday they did away with the Fed call. And I think that's what Steve's implying with that site, with that language, that phrase. We've gone away from unconditional hawkishness. I don't care what you think. I don't care what your forecasts are. I don't care where the data is right now. We can't deal with CPI where it is. We're hawkish. Financial conditions need to be tight. That has changed. And as someone said to me yesterday, arguably that started with the Brookings conversation a couple of months ago. Things started to come into more balance for them. And I wonder if the ECB's gone in the same direction. I don't know. We're going to find out from Lagarde in about 9 minutes.
I think that's perfectly said. Honestly, I think that you framed that really well. I mean, this idea of there has been a shift and the market's reflecting that.
What I'm going to frame is this data screen looks like a follow-on from 3 o'clock yesterday.
That's continued.
I mean, it's just, it wasn't true 2 hours ago, but with these two banks, it is continued.
Before we move on, I just, you know, Lisa's point is really important. You've had that change. That's kind of happened now. Now it's about the data. Payrolls, CPI. Let's see if the labour market ends up looking like the ISMs right now, because then you can have a very different market.
Because of time and to get to Lagarde, we're going to really hustle here, and we are so thrilled to bring you someone truly expert on the political economics and fabric of Europe. Holger Schmieding joins us, chief economist at Berenberg. Holger, I'm going to go to one brilliant sentence in your note. Thank you, France. Thank you, Spain. You made real clear the lift that provides comfort to institutions in Europe as France and Spain are leading the way away from recession. Does that have legs? Can it continue?
Yes, I do think it does have legs. What we are seeing is that Europe as a whole is not falling into a winter recession, but in what you could call a winter stagnation. Germany, most exposed to Russia, is having a contraction in its GDP, but some of the other countries, especially France and Spain, are making up for that. They are not as exposed to Russia as Germany and not as exposed to some downturn or weakness in global trade at the moment. And this is, of course, good news that the region, Europe, which really last year was the focus of all the bad news, war in Europe, energy shock, that Europe is now actually outperforming expectations.
Holger, do you think that in the ECB press conference, Madame Lagarde should push back on the market activity perhaps more aggressively than Jay Powell did yesterday?
That is quite possible. After all, the ECB has de facto pre-announced they're going to do another 50 basis points in March. Thereafter, however, they will re-evaluate their approach, so that leaves the door wide open to going just up 25 basis points in May. And beyond that, we'll have to see. The press conference may provide some clues, but probably the ECB has not made up its mind yet on what happens after March. So Lagarde probably cannot give us clear guidance. Relative to the Fed, what is clear, the ECB, having started later, still has some more room to go to the upside than the Fed from where we are now.
Olga, sufficiently restrictive was this phrase that we heard a lot in December. Do you think we are now?
Well, my personal view is we are sufficiently restrictive, but I'm fairly certain this is not the ECB's majority view. So the majority on the council will want to go further, 50 basis points in March and at least 25 basis points in May, with the risk that they could do more. But as we have seen, for instance, in the January data on Eurozone inflation coming down sharply and more good news in the pipeline for March and April, it probably does not take the ECB to go much further to get inflation back better under control.
Oh, well, can I squeeze this in just quickly? What happened to German CPI this week? And how much can we actually read into the Eurozone CPI data?
Well, the Eurozone CPI data may be revised significantly because simply for Germany, there is a change in the methodology, and apparently the Stats Office was not ready and is not ready to apply that in time. The German data could be weird and raise the Eurozone first estimate somewhat.
What happened to German efficiency, Holger? What happened to that? Everyone looking down their noses
Very
at the
good
UK.
question.
Hey?
We probably have a shortage of qualified staff in many places, including some statistics office possibly.
If that's
Okay,
all you
thank
can cling to.
This meeting of Berenberg. Hey,
Good
usually
luck.
they're so efficient.
I know.
With
So,
the data,
yeah, but
right?
this
You're
is
telling me
this
the
is-
Germans weren't ready for a change in methodology?
Yeah, really? You're going to really put this out there, this battle between the UK and Germany with efficient?
Shocking. Tom, what happened to German efficiency?
It's gone. I mean,
Totally.
but actually, I think I mean, come on, Lisa, help us here. You were at Mercedes. What happened? You know,
It was completely efficient.
it was
I'm
completely.
sure it was very slick
I
there.
think the trains were completely efficient. Everything's on time. It's all neat, and everything is working according to rule. Nothing
Well,
breaks
that's
out.
the way it's been at Bridgewater here for years. We're going to pause here before we get to Christine Lagarde with Sonali Basak on, and I'll not mince words. With all due respect to Bridgewater, I'm absolutely baffled by their third co-chief investment officer. Tell us about Karen.
It really is an amazing story. You had Ray Dalio, remember, stepping down as co-chief investment officer just about 4 months ago. Now this is the post-Dalio era. It is a 37-year-old first woman to lead this post, co-CIO at the world's largest hedge fund. It's a pretty remarkable rise. She joined right out of college, and it's at a very challenging time.
I don't buy this for a minute. She's out of Princeton. I get it in public policy. She's a co-chief investment officer. Like, as compared to Rebecca Patterson, what is her investment abilities?
Well, it's interesting. She, kind of like Nir Bardea, the co-CEO, had come out of the research world. So this is a big win for research across Wall Street. And so she came in 2006, right before 2008. She worked closely with Greg Jensen, Bob Prince, and Ray Dalio in 2008, within 2 years of college, to navigate the financial crisis. Well, she was most recently sustainability. That's a role she took over in 2021, and she helped launch new funds in the wake of the war in Ukraine to capitalize on this energy transition. But I want to be clear, you know, she doesn't just focus on sustainability, and her co-CIOs have really been hinging on this idea of a 1970s era world that we're going to live in now. Let's see how that helps Bridgewater navigate this year.
Now, the culture there is unique. 3 co-CIOs sounds somewhat unique. How's this going to work?
Well, they've had three co-CEOs. It does sound like a crowded room,
You
doesn't
think?
it, with three people there. But I do want to reiterate that Greg Jensen is the one that recruited her out of Princeton. So it's not like they're all new to each other. And so she's worked there for her entire career under the tutelage.
Are they squeezing out Prince? Is that what they're doing?
Well, no, are Prince, what the street wants to know right now is, are Prince and Jensen retiring?
You know, about Prince
Delios
once, I had
says
read, had told her that he can see her taking his job one day. And
Oh,
in
there we
theory,
go.
actually, this is kind of the post that Dalio held, too.
All right, so we just have a couple minutes here until the ECB press conference. You talked about the 1970s kind of scenario. How are they shifting their methodologies in a shifting macroeconomic backdrop?
Yeah, it's a great question because remember that you had Bridgewater really on a run, on a historic tear for the first 9 months of last year. The last couple of months really started to mute some of their performance. They still ended up at their levered Pure Alpha fund, the Pure Alpha 2, up 9.5%. But remember, it's competitive in the hedge fund world. I just got back from Miami Hedge Fund Week
did
where I did last night.
We're
It's
up here
not as
freezing,
fun
and
as
you're
New York
down-
City in many ways, Tom, trust me. Though it's controversial there. But they're all preparing for doomsday, everyone from Paul Singer to Jim Chanos. So it's a very different view than what you're hearing from a lot of this optimism that I walked into today and this idea of a dovish Fed
Yeah, when you
saving
walk
the
in the
markets.
surveillance set, it's very optimistic. There's no question about that.
It sounds like Shania's been hanging out with Taleb, don't you think? Isn't that what it sounds like?
I think so, you know.
Taleb, Jim Chanos, literally everybody's singing sad songs down there, but I guess that's their job.
Well, perhaps the sad songs is the reason why you're seeing such a rip-roaring rally. It's because they're all getting kind of stomped out of the
went down
positioning.
to Miami.
The
Can,
Bears
can we get to
got
the
stomped
news that
out.
we need? Is Bridgewater moving to Florida? That's all that we want to know.
I wouldn't be shocked if they, like many other people, started to put an outpost out there. My
Interesting,
manager has asked me to
outpost.
get there and asked me if Miami was real. And it turns out it kind of is. Lots of companies from Blackstone, people were very excited about Blackstone's presence down there. Lots of people moving down. Another firm told me that people are rotating desks because there's not enough room for the demand. They have to raise pay to bring people down there, a lot of people, because the prices are
Surveillance
so
from the
high.
deck of the Betsy at Miami Beach. I can see it.
Is Miami real?
There's different Miami. Some of Miami is real and some is not.
Is that a bigger
I
statement?
don't know what that means.
Well, have you ever walked on the beach? Never mind.
Okay. Shania, thank you.
Thank you.
This was great. Is it what you think the beach is a fake? Is that what you're saying?
No, I think it's just, is it truly a destination?
Oh, right.
Right.
Do they,
Not-
are they just sort of registered there and not living there?
Exactly. Like,
Okay.
is it?
No, I
is it-
think
or-
people choose to live there.
I think
I'm
people
fairly,
do.
fairly
I think
confident of
it's-
that.
I think it's
They weren't all
pretty nice.
actors. I wasn't in the Truman Show when I was down there.
Are we just in the Truman Show? Is that what?
I think this feels like it's
No,
sometimes.
but seriously, John Miller is great on this, but there's something big going on here, whether it's Texas or Florida. I mean, there
We talked about the
is
numbers, the net migration,
a
Tom.
massive migration.
Without a doubt.
I mean, it's tangible. It's different this time. I remember like when air conditioning clicked in, the South woke up, Atlanta woke up, and all that. No, it's a long time ago. I remember when it was not like that. And then, boom, it happened, and this is a new.
Do you think HQ
Avignon,
down in
It's
Cannes?
gonna be like the Vatican.
Yeah, we should do it in Cannes.
It
And then
could
you've
be
got the
like the
Italians saying, no,
Vatican.
no, no.
You know, the Pope moves to
Amalfi
Avignon.
Coast.
Yeah. Oh, I think you're just
You know.
talking about your vacation plan.
Well, I just think
Does the Fed
we
need
can
to
take the
do
show on
this?
the road with
I
you.
think so.
Yeah.
For the ECB, does the Fed need to do this and have photo shots of
So
of
what
Jay
I like
Powell before
about
he comes
this
out?
and what I like about what the Bank of England does, so you're going to see, I can't see quite that. I think the Vice President is alongside her.
Yeah.
And I think
Maybe
this is really
Philip
good.
Lane,
De Guindos.
perhaps?
And I think that this is, no, the chief economist could be up there too, but I don't think the chief economist is there, Tom. But usually it's the VP, and I think
That's
this is a good
Maria
idea.
taking photos in the front row.
I like this. I like having the VP there. I'd like to see Chairman Powell, the Vice Chair, alongside him too.
think it's
I
a
like
great
this
idea.
tradition at the Bank of England, and likewise at the ECB. What do you make of the podiums? What do you think of that?
It's,
love
it's,
them.
you know,
Like them?
I think that they're
Madame
appealing.
Lagarde's working out. Looks like TV. It looks like TV 24, whatever it is in Paris. Looks good.
I like,
Van
the
Cat.
color,
Venkat,
I like-
whatever it is.
I like the color scheme.
That's very French.
I think we're done. That's De Guindos, all right. That's not Philip Lane, just to clear that up. The ECB President Christine Lagarde about to speak in Frankfurt, Germany. I keep saying this. We show so much respect to the Fed. And it's the ECB and the Bank of England, it's joke time.
Oh,
He was growling earlier.
Hold on a second.
Around the Bank of England.
Was
That
what
was a
we
dissent.
did yesterday respect?
I thought it was highly respectful.
I think that we're respectful of the decisions that they have to make.
The ECB President, Christine Lagarde.
For those who are overseas. The Vice President and I welcome you all to the press conference and we would like to begin this press conference by congratulating Croatia on joining the euro area on January 1st, 2023. We also warmly welcome Boris Vucic, the governor of Vatska Narodna Banka, the National Central Bank of Croatia. We will now report on the outcome of today's meeting. The Governing Council will stay the course in raising interest rates significantly, at a steady pace, and in keeping them at levels that are sufficiently restrictive to ensure a timely return of inflation to our 2% medium-term target. Accordingly, the Governing Council today decided to raise the 3 key ECB interest rates by 50 basis points, and we expect to raise them further. In view of the underlying inflation pressures, we intend to raise interest rates by another 50 basis points at our next monetary policy meeting in March, and we will then evaluate the subsequent path of our monetary policy. Keeping interest rates at restrictive levels will over time reduce inflation by dampening demand, and will also guard against the risk of a persistent upward shift in inflation expectations. In any event, our future policy rate decisions will continue to be data dependent and follow meeting by meetings approach. The Governing Council today also decided on the modalities for reducing the Eurosystem's holdings of securities under the asset purchase program. As communicated in December, the asset purchase program portfolio will decline by 15 billion euros per month on average from the beginning of March until the end of June 23. And the subsequent pace of portfolio reduction will be determined over time. Partial reinvestments will be conducted broadly in line with current practices. In particular, the remaining reinvestment amounts will be allocated proportionally to the share of redemptions across each constituent program of the APP and under the public sector purchase program to the share of redemptions of each jurisdiction and across national and supranational issuers. For our corporate bond purchases, the remaining reinvestments will be tilted more strongly towards issuers with a better climate performance. Without prejudice to our price stability objective, this approach will support the gradual decarbonization of the Eurosystem's corporate bond holdings in line with the goals of the Paris Agreement. The decisions taken today are set out in a press release available on our website. The detailed modalities for reducing the APP holdings are described in a separate press release which will be published at 3:45 local time. I will now outline in more details how we see the economy and inflation developing, and will then explain our assessment of financial and monetary local time. I will now outline in more details how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. So looking at the economic activity first. According to Eurostat's preliminary flash estimate, the euro area economy grew by 0.1% in the fourth quarter of 2022. While above the December Eurosystem staff projections, this outcome means that economic activity has slowed markedly since mid-22, and we expect it to stay weak in the near term. Subdued global activity and high geopolitical uncertainty especially owing to Russia's unjustified war against Ukraine and its people, continue to act as headwinds to euro area growth. Together with high inflation and tighter financing conditions, these headwinds dampen spending and production, especially in the manufacturing sector. However, supply bottlenecks are gradually easing. The supply of gas has become more secure. Firms are still working off large order backlogs, and confidence is improving. Moreover, output in the services sector has been holding up, supported by continuing reopening effects and stronger demand for leisure activities. Rising wages and the recent decline in energy price inflation are also set to ease the loss of purchasing power that many people have experienced owing to high inflation. This in turn will support consumption. Overall, the economy has proved more resilient than expected and should recover over the coming quarters. The unemployment rate remained at its historical low of 6.6% in December 2022. However, the rate at which jobs are being created may slow, and unemployment, high energy prices should be temporary, targeted, and tailored to preserving incentives to consume less energy. In particular, as the energy crisis becomes less acute, it is important to now start rolling these measures back promptly in line with the fall in energy prices and in a concerted manner. Any such measures falling short of these principles are likely to drive up medium-term inflationary pressures, which would call for a stronger monetary policy response. Moreover, in line with the EU's economic governance framework, fiscal policies should be oriented towards making our economy more productive and gradually bringing down high public debt. Policies to enhance the euro area's supply capacity, especially in the energy sector, can help reduce price pressures in the medium term. To that end, governments should swiftly implement their investment and structural reform plans under the Next Generation EU programme. The reform of the EU's economic governance framework should be concluded rapidly. Turning now to inflation. According to preliminary Eurostat's flash estimate, which has been calculated using Eurostat estimates for Germany, inflation was 8.5% in January. This would be 0.7 percentage point lower than the December figure, with the decline owing mainly to a renewed sharp drop in energy prices. Market-based indicators suggest food price inflation edged higher to 14.1%, as the past surge in the cost of energy and of other inputs for food production is still feeding through to consumer prices. Price pressures remain strong, partly because high energy costs are spreading throughout the economy. Inflation, excluding energy and food, remained at 5.2% in January, with inflation for non-energy industrial goods rising to 6.9% and services inflation declining to 4.2%. Other indicators of underlying inflation are also still high. Government measures to compensate households for high energy prices will dampen inflation in 2023, but are expected to raise inflation once they expire. At the same time, the scale of some of these measures depends on the evolution of energy prices, and the expected contribution to inflation is particularly uncertain. Although supply bottlenecks are gradually easing, their delayed effects are still pushing up goods price inflation. The same holds true for the lifting of pandemic-related restrictions. While weakening, the effect of pent-up demands is still driving up prices, especially in the services sector. Wages. Wages are growing faster, supported by robust labor markets, with some catch-up to high inflation becoming the main theme in wage negotiations. At the same time, recent data on wage dynamics have been in line with the December Eurosystem staff projections. Most measures of longer-term inflation expectations currently stand at around 2%, but these warrant continued monitoring. Turning to our risk assessment. The risks to the outlook for economic growth have become more balanced. Russia's unjustified war against Ukraine and its people continues to be a significant downside risk to the economy and could again push up the costs of energy and food. There could also be an additional drag on euro area growth if the world economy weakened more sharply than we expect. Moreover, the recovery would face obstacles if the pandemic were to re-intensify and cause renewed supply disruptions. However, the energy shock could fade away faster than anticipated, and euro area companies could adapt more quickly to the challenging international environment. This would support higher growth than currently expected. The risks to the inflation outlook have also become more balanced, especially in the near term. On the upside, existing pipeline pressures could still send retail prices higher in the near term. In addition, a stronger than expected economic rebound in China could give a fresh boost to commodity prices and foreign demand. Domestic factors such as a persistent rise in inflation expectations above our target or higher than anticipated wage rises could drive inflation higher also over the medium term. On the downside, the recent fall in energy prices, if it persists, may slow inflation more rapidly than expected. This downward pressure in the energy component could then also translate into weaker dynamics for underlying inflation. A further weakening of demand would also contribute to lower price pressures than currently anticipated, especially over the medium term. So let's now look at the financial and monetary conditions. As we tighten monetary policy, market interest rates are rising further and credit to the private sector is becoming more expensive. Bank lending to firms has decelerated sharply over recent months. This partly stems from lower financing needs for inventories, but it also reflects weakening demand for loans to finance business investment in the context of a steep upward move in bank lending rates and a considerable tightening in credit standards, which is also visible in our most recent bank lending survey. Household borrowing has continued to weaken as well, reflecting rising lending rates, tighter credit standards, and a sharp fall in the demand for mortgages. As loan creation decelerates, money growth is also slowing rapidly, with a marked decline in its most liquid components, including overnight deposits, only partially compensated by a shift to term deposits. So summing up, the Governing Council will stay the course in raising interest rates significantly at a steady pace and in keeping them at levels that are sufficiently restrictive to ensure a timely return of inflation to our 2% medium-term target. Accordingly, we today decided to raise the 3 key ECB interest rates by 50 basis points, and we expect to raise them further. In view of the underlying inflation pressures, we intend to raise interest rates by another 50 basis points at our next monetary policy meeting in March, and we will then evaluate the subsequent path of our monetary policy. Keeping interest rates at restrictive levels will over time reduce inflation by dampening demand and will also guard against the risk of persistent upward shift in inflation expectations. Moreover, from the beginning of March 2023, the APP portfolio will decline at a measured and predictable pace, as the Eurosystem will not reinvest all of the principal payments from maturing securities. Our future policy rate decisions will continue to be data dependent and determined meeting by meetings. We stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target. And we are now ready to take your questions.
Thank you, President Lagarde. And the first question for Jana Rando of Bloomberg News. Jana, please.
Jana Rando with Bloomberg. Good afternoon.
Good afternoon.
I was wondering if you could give us a little bit or can you tell us a little bit about the flavor of the debate that preceded today's decision to raise interest rates by 50 basis points in March? I'm interested in knowing whether there were any calls to commit for longer, potentially flag a less aggressive stance, or say nothing at all, given that you also say that your decisions are data dependent. That would be my first question. And the second one, I'm interested when you say the subsequent policy path will be decided in March. Are we just talking about the pace of rate increases, or could one potential conclusion also be that you have already reached the peak in interest rates at that time? Thank you.
Thank you very much. Those are really good questions to try to explain our decision. And I would just remind you that our decision is not the decision for March. We're taking a decision as of now, which is to raise all 3 interest rates by 50 basis points. I would characterize our good discussions with an enlarged governing council, given that we are now 26 around the table. I would characterize them as marked by the sign of continuity and consistency. And I know that I have repeated that in the course of the monetary policy statement, and I have said it before, but the expression, "we shall stay the course," or "the governing council will stay the course," is a good way to express that double principle of continuity and consistency. Continuity because we were very clear in December that in all reasonable scenarios, significant rate increases would be needed. Would be needed for what? To bring inflation back to the 2% medium-term objective that we have in a timely manner. And we also made it clear that this would require rates to rise to sufficiently restrictive levels, and that rate increases would happen at a steady state. So we are really making that decision in that continuity that I have tried to explain. Steady state, we increased rate by 50% in December. We increased rate by 50 basis points in early February, and we intend, which is a strong word. It's not an absolute, irrevocable, unconditional commitment, but it's a strong word. We intend to raise by 50 basis points, and that is what was meant in December by this steady state reference that you find yet again in the monetary policy statement. So this has been the continuity. Where we have consistency is consistency with the communication that we had back in December and with any communication that I have expressed ever since. And it's totally consistent with the view that we reached in a very, very large consensus today, that it should be 50 this time around. It is intended to be 50 in March. Now you will say, well, yes, but what about after March? Does that mean that you have reached the pinnacle or the peak? No, 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 no. We know that we have ground to cover. We know that we are not done. What we are saying is that as we will receive projections, we will need to assess what rates, what level, at what pace it will be needed in order to do the two things which in my view are embedded in my expression, stay the course. The first one is to raise significantly into two restrictive levels, and two, stay there for sufficiently long so that we are confident that at those rates we will actually deliver the 2% objective medium term that we have set for ourselves and which is delivering on our mandate. So those were the themes that we debated. I have to tell you that there was general agreement on the fact that the 50 basis point this time around and the 50 basis point in March were legitimate on the basis of, particularly in March, of the underlying inflation pressure that we know will continue. I think where there was discussion and not full agreement was on the way in which we communicated. But on the overall monetary policy statement that reflects our discussions and our decision, there was a very, very large consensus. So I hope I have addressed your two important questions.
Thank you, President. The second question goes to Balazs Korani of Reuters. Balazs, please.
Good afternoon, Balazs Korani from Reuters. Thanks for taking my questions. President Lagarde, back in Davos, you said doubters should revise their positions if they don't believe that you're serious about inflation. But markets are again doubting you because the reaction to this decision was for financial conditions to actually ease a bit and expectations to come down. So what would you say to doubters today? And when you just told Jana that you have ground to cover, we are not done, are we correct to interpret that more rate hikes are coming beyond March at an unspecified rate? Is that what you meant? The second question is about the signals that you're sending. I mean, gas prices have come down to pre-war levels. Oil is down by a third since the summer. Your lending data is showing the biggest liquidity lending crunch since the debt crisis. Growth is at a standstill. There are lots of deflationary or at least disinflationary forces in the economy. So why would you set a guidance without having seen your projections? And why would you keep on providing a guidance when you said you would stop doing it? So I'm trying to understand the logic of how you communicate and why it's meeting by meeting one day and then you provide a guidance the next. Sometimes it's difficult to read what the ECB intends according to the people that we speak to.
Which is why I'm trying to, explain a bit better our reaction function. And I've tried to do that with Jana, if I may call you so, given that you do. But I will happily try to re-explain a bit what our intention is. First of all, we are data dependent, and we know that we're getting a projection exercise at our next March meeting. But we are also data dependent when we look at underlying inflation elements, and the underlying inflation pressure seems to be, whether you look at core, trimmed, super core, in all sorts of dimension, adding to which the measurement of the fiscal measures that have been put together, the wage negotiations and the wage direction that we are seeing, we have all scenarios available to decide that March actually warrants a 50 basis points increase. And this is what we are saying when we say we intend to, which is why the word is pretty strong. Now, in Davos, I did say that we shouldn't be doubted, and I think it was very much in relation to what we were going to do this time around and what we were going to do in the following meeting. And I hope that by being very specific about today's decision and pretty strong in terms of intention as to what we will do in March, those who observe carefully what we do will appreciate that we should not be doubted. And our determination to reach 2% medium-term inflation should not be doubted. And our determination to raise rates sufficiently significantly in order to move into restrictive territory should not be doubted. Nor should be doubted the fact that once we are in restrictive territory, we will want to stay there sufficiently so that we can be confident that those rates will give us the return to the 2% medium-term inflation objective that we have. Now, you will say, is that consistent with the meeting-by-meeting approach? You know, let's call a spade a spade. Meeting by meeting is going to be applied on the basis of data. But when we have data that is sufficiently strong, and when we are sufficiently far away from what we expect will be the appropriate rate to reach the 2%, it is completely legitimate to express an intention in a relatively forceful way. An intention is not, as I said, 100% commitment, but it's a pretty strong determination. And I can't, think of scenarios, unless they were quite extreme, where that would not happen.
Thank you, President. The next question goes to Annette Weisbach of CNBC. Annette, please.
President Lagarde, thank you very much for taking my question. I have one question on whether you're also discussing the negative side effects of your now policy raising rates substantially and very fast, especially on sectors like the real estate sector, and what it could also mean for the banks and balance sheet and consumption going forward. And then my second question goes on to QT, quantitative tightening. Perhaps you can explain a little bit more what you think you want to achieve with it, and whether there's also discussion to accelerate it and use it as an efficient policy tool. Thank you very much.
Yeah. You know, the occasion of this meeting was a very appropriate way to try to measure the effects and the consequences of our most recent monetary policy decisions. And it was so because we had the bank lending survey, which really helps appreciate how banks themselves see the rates that they will be offering, depending on whether they offer financing to corporates or to households or for consumption purposes. And it's also a good opportunity to have them assess for us in that survey whether they are going to tighten terms and conditions or not. Final point that we draw from those bank lending surveys that I'm sure you had a chance to look at as well is how they see the risk assessment proceed and develop as the situation evolves. And I would say that all that we are seeing, which is a tightening of the financing terms and conditions, higher rates across the various sectors of lending, is actually good transmission of our monetary policy. It's not the entire transmission, because by the time the investments is possibly reduced, financing is more expensive, impacts will channel through into the real economy. But we can tell, that there is transmission of those rates already. And that was part of the propositions that we had, obviously. We are hearing the banks, and we have good dialogues with the banks on impacts that all our measures have. Our measures have impact on interest rates as well, in a different direction. So we are attentive to that, and of course we are attentive to financial stability, and this is something that comes into the decision-making process that we follow. But our objective is to reduce inflation, not just to reduce inflation, to drive it down to 2% in the medium term. So there will be consequences. There will be secondary effects as far as banks are concerned, inevitably. Now, you asked me also about the what I would call the balance sheet normalization. And I would preface that with the fact that in the current circumstances, our main tool is, of course, the interest rates. And the balance sheet normalization is helping us normalize the process, and it's not the main instrument. It's obviously part of the accessory instruments, if you will, that come to supplement the interest rate policy that we have. I think the approach that we have taken was also telegraphed back in December when I said in this room that it would be predictable and measured. And I did mention the 15 billion monthly over a period of 4 months from March to the end of June. That's what we're doing. So yet again, continuity, consistency in that partial reinvestment of the APP portfolio. And I think we're adding 2 principles that will matter, which is simplicity and neutrality, so that we don't do things in an awfully complicated manner, and we simply apply the proportionality principle to the portfolio across jurisdictions. Thank you.
Thank you, President. And the next question goes to Aude Kurselek of the French television channel BFM Business.
Good afternoon, Madame Lagarde, and thank you for taking my questions. First one, could you say it was a compromise between governors to nearly decide of 3 hikes of 50 BPs in a row from December to March? Does regularity matter to you? And does that mean it could continue at this pace in May? And a second question, in many sectors, company and institutions as well, employees are asking for salary increases. What's your message about that? And at what point do these increases become dangerous with the risk of entrenching inflation? Thank you.
Well, thank you for your question. Any decision is the fruit of a compromise. And the beauty of the Governing Council is that all governors are passionate about the rationale, the analysis, the hard econometric work that is behind what we do. And some take particular views, others other views, and they come to these meetings informed by their staff and by the work that they have done at home, within the Eurosystem, but in the national central banks. And the beauty of the exercise for me is to see how they can coalesce towards solutions that are recommended by our chief economist, Philip Lane, that I fully support, and that inevitably have elements of compromise about them. So compromise is the rule of the game, which does not weaken the fact that we're riveted to the mandate and that we know that we have to stay the course because we are not done. Your second question had to do with the wages, and it's a truly important aspect of inflation. It's a component that plays a critical role in the service sector in particular, which is far more labor intensive, and where we are looking and scrutinizing evolutions both in terms of negotiated wages at collective level through unions and manufacturers associations, but also we are trying to really dissect as much as we can, and we have built, as you know, a special wage tracker that now includes 9 countries of the 20 members of the euro area. So critically important, and we know that there is an element of catch-up that is at play now, because obviously most recent numbers were high. Headline inflation numbers matter a lot. The fact that it went down to 8, well, at least preliminary until we have the German numbers, that it went down to 8.5% in respect of those anticipation by unions or by workers is better in a sense, but it's a critical component that we will be looking at extremely carefully. And I think it's important. I know it's easier said than done, but it's important in those discussions and negotiations that there is a forward-looking approach to what inflation will be and how soon we will return it back to 2% in order to really appreciate the trend of wages that are discussed between the parties. Thank you.
Thank you. Turning to WebEx now, I'd like to give the floor to Delphine Strauss of the Financial Times. Delphine, over to you, please.
Thank you very much. Could I perhaps ask you to talk a little more about which elements of current inflation developments you're most concerned by, and how that differs from the economic environment at the moment in the US?
Thank you very much. Welcome on WebEx. What are we particularly attentive to in terms of inflation development? Now, obviously, we have to look at energy, because energy has been a key driver when inflation went up massively and went far too high. It is still far too high, by the way. So we have to look at energy costs because it might transmit, and at which pace we don't know, and we will be observing that very carefully, into underlying inflation elements. We are looking, as I just said to your colleague, very carefully at wages. Wages will be a significant component of inflation pressure in the months to come. We are looking at fiscal measures. And on the fiscal front, we have seen a lot of measures that were decided and part of the 2023 budget of euro area members. Some of them are going to try to recalibrate, others might not. And we had an excellent discussion with Pascal Donoghue, the president of the Eurogroup, yesterday. He came and participated in our discussion yesterday afternoon, and we had dinner together. So it was a very good opportunity to appreciate how the Eurogroup at finance ministers level is going to look at the fiscal measures, is going to look at recommending recalibration in order to make sure that fiscal support will be adjusted to the lower energy prices, which we do not see at the moment yet. So I would say that those are the key components. But what shall I say? On the international front, because I think that you raised a comparison with the US. I'm not going to compare with the US necessarily, but I need to bring into our consideration the international environment. The consequences of the Chinese authorities' decision in December to do away with zero COVID, to reopen the economy, come what may, are going to come with consequences. Consequences on demand, consequences on demand addressed to the rest of the world, consequences on exports, but also consequences on the price of commodities. If you start looking at the price of metals in particular, there has already been an anticipation of how commodities are going to rise as a result of the Chinese reopening. So there will be inflationary, disinflationary forces, the exact detail of which I believe I will be able to say a bit more at our next March meeting, because we will be looking into that in the next few weeks. But that's also a country, the role of which we will be looking at very carefully. Thank you.
Thank you. And the next question goes to Marta Izan of the Spanish Negocios TV channel.
Thank you so much for having my question, for taking my question, Mrs. Lagarde. I know you just said you're not going to compare with the US, but Powell said yesterday that the economy's disinflationary process has started. How far is Europe from being able to say the same? And another question, you said the decrease in inflation rate is primarily related to energy. So does this mean that the decrease is not due to the actions of the ECB? Do you expect the 2% in the medium term? And what is exactly the medium term?
Far from me to say that monetary policy is not potent and efficient. I think that what we are seeing in our bank lending survey, in the cost of financing in particular, is clearly an indication that there is transmission of our monetary policy and our interest rate hikes decision, clearly. So that is definitely working. But it's also true that a large portion of that too high inflation was attributable to the supply shock provoked by very high energy prices, and one that we did not really capture so well, which was gas prices and the impact it had on electricity cost. So we have to be attentive to those energy components, and we have to be attentive to the pace of transmission and the pass-through of those costs into other inflation component. But I would certainly not say that the disinflationary process at large and without qualification is already at play. When I look at core inflation, which is, by far not the only component that we look at many more of those. But when I look at core inflation, we were at 5 in November, moved up to 5.2 in December, stayed at 5.2, and this is the highest in all time that core inflation has been in our part of the world. So I get it, headline inflation has gone down, and more so than we had expected, and that many had expected. But underlying inflation pressure is there, alive and kicking, which is why we are committing, as we are intending, as we intend in this monetary policy statement, and this is why I say that we have more ground to cover and we are not done.
Thank you, Madame Lagarde. And the next question goes to Jan Marleen of Handelsblatt. Jan, please.
Hello, Madame Lagarde. Thank you for the opportunity. A statement, you described the risks to the inflation outlook as balanced.
No, I say more balanced.
More balanced compared to December. Could you say something about how important that is for the future rate path? And my second question also relates to that. Was that controversial within the council? Were there different views about that? Thank you.
Well, thank you very much for your question. I think the whole paragraph that you have in the monetary policy statement on risk assessment and I'm not going to offend you by reading it to you because I know that you have it, but it really focuses on in which way is this risk assessment more balanced, not balanced. We don't think that there is symmetry of risk, but it is more balanced than it was back in December, for sure. And it lists the various points that are upside risk, downside risk on both account on activity and inflation. Because my governors around the table of the Governing Council are genuinely interested in analyzing, understanding, and coming to as well-based conclusion as is possible, there was not a lot of discussion on that particular paragraph. It was a rather consensual assessment of the more balanced risk. At this point in time, we will obviously reevaluate and assess again at the March meeting. Thank you.
Thank you. Returning back to WebEx, I would like to give the floor to Fabrizio Goria of La Stampa in Italy. Fabrizio, please.
There you go. Hello, thank you, President Lagarde, for taking my questions. There are two questions. The one is about the BLS survey and is about the credit crunch risks in the medium term. Do you see that? And the second one is about the TPI, the Transition Protection Instrument that you mentioned in the statement. In this case, do you see any risks of market turmoil in the bond market? Thank you.
Thank you very much for your two questions. On the bank lending survey, as I said to one of your colleagues, we draw a lot of conclusions, learning, understanding of how our monetary policy, and particularly the interest rate policy that we have developed ever since July, is actually transmitted via the banks to corporates and to households and to consumption loans as well. And we believe that this impact is, in a way, efficient and necessary given what we are trying to do in order to reduce inflation and bring it back to 2%. The transmission protection instrument that was put in place, just to refresh our memory, because that goes back to June, was intended, sorry, July, wasn't it? Anyway, it was about 6 months ago, was intended to protect the transmission throughout the entire euro area. And it is available, it is there, it will be used if necessary. It is not the first line of defense. As you know, we have flexible reinvestment under the PEP as the first line of defense. If we were to see that transmission being impaired for non-legitimate reasons, but it is there and it is available. We don't see a need to use it at the moment, but should it be needed, we will indeed use it. Thank you.
Thank you. And the next question goes to Takari Minami of Nikkei. Takari, please.
Good afternoon. Thank you for taking my questions.
Good afternoon.
And investors and the financial markets expect that the ECB will finish raising interest rate in coming April, for example, by the meetings in May. So, as you mentioned, I know well, so it depends on the coming data, but do you think such expectations are correct or wrong? Thank you.
You know, I'll go back to what we intend to do, or what we actually shall do, not intend to do. We shall return inflation to 2% in the medium term, in a timely manner. And we know that to do that, we need to move into restrictive territories, to restrictive levels. And we know that rates are the best tool in order to do so. So we will use interest rate hikes in order to get to those levels. And as I said, we are certainly not there now, nor will we be in March, given that we will rely on inflation, underlying inflation indicators and pressure that we see very, very clearly nowadays. What will happen next, as I said earlier on, is going to be a factor of how much more ground we need to cover. And there will be ground to cover most likely, but it will be data dependent. We will look at all components. And it will depend on the interest rates, where we are then, and where we believe we need to be in order to deliver on our commitment. But that will not be enough. We will have to stay there. So it's moving into restrictive territory because we know that's needed, given the elements that we have. But it's staying there so that we are confident that we don't touch the 2% for a few weeks, a few months, but that we have confidence that we will stay at target. So I hope that that satisfies your your question. I'm tempted to ask you a question because we've been debating as to when the governor of the Central Bank of Japan, my good friend Mr. Kuroda, will have to step down. And there was big discussion internally in the House as to when it was, but you will tell me later.
Thank you. And the next question goes to Santiago Pinol of Market News International. Santiago, please.
Hi, good afternoon.
Good afternoon.
My question is following my colleagues too. It's on December you said that the ECB was going to raise rates 50 in February, possibly 50 in March, and possibly maybe in May. I was asking you, like, how is seen now May? Because I don't know if it's less possibly than it was in December. And also on bonds, I would like to ask you, like, ESG bonds are constantly linked with greenwashing. How will the ECB manage the increased reputational risk implied by tilting bond purchases toward issuers with a better climate performance? Thank you.
Well, thank you very much for your questions. I think in December we mentioned significant, we mentioned steady rate, steady pace. In a steady manner, I think that's what we had used. And I said later on that our determination should not be doubted. It was 15 December, 15 February, we're doing it, and we intend, which is strong, as I said earlier on, to do 50 basis points based on the underlying inflation pressure that we see, anticipate, and are not going to go away. I'm not suggesting that it will be steady pace for an ongoing basis. What we're saying here in this monetary policy statement is that we will assess the situation, evaluate our monetary policy path on the basis of our projection. It might be 50, it might be 25, it might be whatever is needed, whatever rate is needed. I should say whatever rates are needed. We have 3, and then at whichever pace, in order to deliver on our 2% inflation target in the medium term that we want to reach in a timely manner. And we are far away from that. Inflation is still far too high today, in particular when we look at underlying inflation components. So, did you have another question? Yes. Oh, yes, of course, yes. Are we at risk of greenwashing? You know, as determined as I've always been, and you know me, it's been more than 3 years now. So as determined as I am to deliver on our strategy review and the action plan that we have all agreed around the table of the Governing Council, to deliver in alignment with the Paris Agreement. Equally, we have to manage risk. And managing risk, to me, is having as clear, as distinguished, as transparent information and disclosure as possible, a good understanding of the transition plan by the corporates that we eventually reinvest into, and a good understanding of the footprint that they have. And it will be on the basis of that analysis, our own, and also reliable analysis that will be provided by experts, that we will orientate our portfolio with a stronger tilting than we had so far. But we will be very attentive because it's just, we should not be accomplice to greenwashing, and it's a risk management principle that we have to comply with.
Thank you. And the last question is for Eric Albert of Le Monde. Eric, please.
Thank you very much. Good afternoon, Mrs. Lagarde. I'm here. A couple of questions. I'd like to come back to the fiscal message, the message you want to send to government. You said they should recalibrate. Is it really the right time to pull the plug when food inflation is at 14% and energy prices are indeed going down but are still hurting a lot of households? And the second question, if I may, is do you believe your course of action is basically in line with a soft landing? Because growth is basically zero already. Inflation is going down, and the hikes that you've put through will take months to really go through the economy. So is there a danger to go too far, basically, or does it look like a soft landing to you?
Great questions. On your first one concerning fiscal, I just want for everybody's good understanding, because it's a sentence that we discussed quite extensively this morning. It's in the section on economic activity. So it reads, and that's in relation to government support, that we say will shield the economy from the impact of high energy prices, you're right. But then we say, in particular, as the energy crisis becomes less acute, it is important to now start rolling these measures back promptly in line with the fall in energy prices and in a concerted manner. So it's not it's not asking governments to stop now, but they clearly have to align their fiscal support with the energy price impact at retail level when it comes to supporting consumers, and at corporate level whenever it hits corporate. But many of these measures were decided in the course of the budgetary cycle, which it starts in the summer, it's active work in September, voted in December, and the measures apply throughout the whole of 23. And what if that recalibration does not happen for those measures that were not subject to variation of energy prices and therefore would automatically adjust, then the other measures should be thought through and reconsidered, not with a view to remove the shields, but simply taking note of the fact that the shield is not as badly needed as it was. So I think that's our advocacy to governments, and it's something that we discussed with the president of the Eurogroup yesterday in particular. So on the monetary policy decisions that we are making, as I said, we are riveted to staying the course, to move into restrictive territory sufficiently and for long enough so that we're confident that we return inflation to 2%. There are some good news because, growth, which was expected to be negative in the fourth quarter of 22, is eventually slightly positive. Now, we Europeans always beat our chest and we're going to say that, well, if you take this out and this out and this out, it's not so positive. I think we should celebrate that we are not in negative territory on the growth front. Headline is going down, which I think is going to be important, in particular for the wage negotiations that will be coming up. But we still have underlying inflation factors that are strong, solid, and are not budging. So we need to do our job. We need to deliver on our mission.
Thank you. That finishes the press conference. Next meeting and press conference is 16 March. Until then, all the best to all of you. Thank you very much.
That was ECB President Christine Lagarde in Frankfurt, Germany. I'm Jonathan Farrow, live from New York. Let's get straight to it. Two quotes that matter in the last 24 hours. One from Chairman Powell, one from President Lagarde. Chairman Powell, the disinflationary process has started. President Lagarde, the risk to inflation and the outlook are more balanced. This is important. There is a difference between what central bankers tell us and what markets actually hear. The central bankers are saying this: Lagarde, we know we're not done. Powell, we've got more work to do. This is what the market hears. You're basically done. Here's the equity move about 16 minutes into the session. We're flying up 6 or 7 tenths of 1% on the S&P, on the NASDAQ, up another 2.2%. Meta, we'll talk about that in a moment. That is rallying and rallying really hard. In the bond market, the rally continues, yields lower. In the treasury market and in Europe too, we're down 15 basis points at the front end in Germany, 252. In Italy, monster moves, down 33 basis points on an Italian 10-year, south of 4%, 396. Guess where the euro is? Euro-dollar looks a little something like this, negative 0.7%. We had a little look at 110 earlier, now 109.16. The president, Christine Lagarde, had this to say.
It should be 50 this time around. It is intended to be 50 in March. Now you will say, well, yes, but what about after March? Does that mean that you have reached the pinnacle or the peak? No, 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 no. We know that we have ground to cover. We know that we are not done.
Joining us now to discuss is Maria Tadeo, outside of ECB HQ. Maria, what do you make of that one?
Well, Jonathan, to me, this was on paper should have been an easy press conference because the statement put everything on paper again, very clearly stated. 50 basis points today, another 50 basis points come March. In the press conference, however, there was what I would say a very delicate balancing act with Madame Lagarde insisting we have to do our job, bring inflation back to target. We're not done yet, and therefore we have that commitment, but also suggesting we are data dependent too. She pointed to large consensus, but did not use the word unanimity when it comes to the decisions taken. And then she also suggested there had been some divergence at the core of the Governing Council when it comes to the communications. So the way that the European Central Bank communicated, not just this move, but the one potentially in March, around the March decision also. She said intend to do something is a strong word, but it would not qualify as 100% done deal at times. So to me, again, it was a tug of war at times between wanting to sound very tough, this commitment line, but then also saying we have to look at data dependent, and at times that merits a revaluation of things.
Maria, fantastic coverage throughout the afternoon over there in Europe. Thank you. I'm pleased to say that joining us now is Pictet's Alahodja and Saul Perkins, Michael Purvis alongside us as well. To the both of you, I just want to start with the compare and contrast, and it's very much a compare exercise between Chairman Powell and President Lagarde. Take a listen to this.
Risks to the inflation outlook have also become more balanced.
The disinflationary process has started.
We know that we are not done.
There's work left to do.
Michael Purvis, the central bankers are saying one thing. Are you hearing something else?
Well, look, John, I think there's a game of catch up here that between the ECB and the Fed. Christine Lagarde is still sort of where Powell was a little bit last summer here. I think Powell is in a difficult position in a way because he's got to manage the financial conditions, but there's only so much he can do on those lines because Christine, as the marginal hawk, right? She may not have been as hawkish as some might have guessed, but she is making the euro ultimately a little bit stronger relative to the dollar, and that's going to feed back into easier financial conditions. And I think the other thing is that the rates market over here in the United States is very much the positioning has been extremely bearish across 2s, 5s, 10-year future positioning. It's extremely bearish coming into this press conference, right? So the market reaction has to be contextualized, I think, for some of the simple fact that a lot of this positioning has been just super, super bearish. The other thing is that there is a very, if you look at the terminal rate pricing for the Fed, that has been rightfully or wrongfully, that's been very, very stable since November, right? And the timing of that is really focused on May and June. You don't have that with the ECB there, right? So that's ultimately going to help sort of, certainly reduce Treasury volatility here in the United States. And it's also going to create sort of, more confusion, I think, regarding where the ECB is with respect to rates on a relative basis.
Mike, I want to get Ella into the conversation as well. Ella, your thoughts on the central bank decisions from yesterday and this morning?
Well, I mean, they've done everything they could to sound hawkish, and the market, as you say, has taken a very dovish interpretation, so it's very difficult to fight that. And to us, it just means that the market thinks we have peaked, or at least we are close to peaking. Now, how does that play out? I mean, we've been pretty much doing this soft landing scenario where everything sort of works beautifully, immaculate disinflation, as some might call it. And basically that does give, fuel to the rally, whether it's in rates, core rates, or whether that's in equities, credit, et cetera, or even riskier currencies. So, look, the way we're thinking about this is the following. It's the jury is out in terms of, are we going to get a recession? How soon in the US? And does that mean that the Fed will actually cut rates? Or is the stickiness in wages and a very tight labor market sufficient to keep the Fed, tighter for longer? And we would probably stay with the latter risk. When it comes to the ECB, the key takeaway is they're sort of waking a little bit late to the party in terms of wanting to be more hawkish.
Yep.
But in reality, their constraints will limit how far they can go. But I do agree that we might get more volatility around European rates, and we're really sort of playing that on a relative basis. So we're using that market to sort of.
Hello, this is Bloomberg Television.
Incredibly painful stuff, Ella, if you're on the wrong side of this. The rally we're seeing at the moment, the S&P 500 up by more than 8% year to date. On the NASDAQ 100, we're absolutely flying by 15, 16%. Ella, are you saying you'd lean against that?
Well, actually, it's a little bit soon to do that.
Hi, this is Bloomberg. Do you hear me? Would you be able to turn your...
I think we may have a connection problem with Ella. Ella, I'm sorry. Let's go straight to you, Michael, on the same question if we can. The move we've got at the moment, Mike, we've got equities up year to date by 15 or 16% on the NASDAQ. On the S&P, we're flying as well. Would you lean against that, Mike?
Not yet, no. I think we've got a couple things going on here. The economic data in the U.S. was expected to contract quickly. It's contracting very slowly. The same thing can be said for earnings. There's a malaise, but it's not dropping like a stone. And against that, you've got a stronger European economy and the China reboot that's sort of underscoring global growth there. And you got a dollar that since October, November has been in a weakening trend there. So we're in a very different place here. Positioning again has been very bearish across not just rates, but also in equities. So this thing is gonna fly higher. I'm targeting a VIX to 15, maybe even lower for this move.
Wow.
But that doesn't mean we're out of the woods. That does not mean we're out of the woods.
I apologise for that connection problem. Michael Purvis there at Toolback, and to Ella Hodger as well. Ella, let's reschedule a conversation and hopefully we can catch up again soon. Some of these moves are absolutely phenomenal, not just in the S&P 500 or in the bond market, but in the NASDAQ off the back of this move in Meta. Shares soaring after the company reported better than expected revenue. The CEO, Mark Zuckerberg, striking a new tone with investors. Our management theme for 23 is the year of efficiency. There's going to be some more that we can do to improve our productivity, speed and cost structure. Ed Ludlow on the West Coast with more. Ed, you're going to be a busy man a little bit later this afternoon.
Yeah, look, analysts are cheering this, the stock having its biggest jump in almost a decade, the focus on efficiency and cost cutting. Also a bullish forecast for revenue in the first quarter, right? 26 to 28.5 billion. Even the midpoint was above analyst expectations for that quarter, but the focus very much on operating expenses. 89 to 95 billion dollars in full year 23, a trim of 5 billion from their previous estimate. The stock is now up, John, pretty significantly from that November 3 low, but another way of looking at it is Meta adding $200 billion of market cap since that November 3rd low. The other big piece of news, of course, is Meta boosting its stock buyback authorization by $40 billion, adding to the almost $11 billion that was already out there in repurchase programs. How much is the market cheering that? The market loves buybacks. A surprise. Facebook, yes, the legacy platform Facebook hitting 2 billion daily users. That's a jump of 70 million from the same period a year ago. This is a social media platform that is 2 decades old, and you look at the sell side, they're saying, actually, Meta's responded, made product tweaks, and the consumer base likes it, the market likes it.
Ed, thank you, buddy. As always, looking out for earnings a little bit later from Amazon, Apple, and Alphabet. Meta absolutely flying. Your day ahead looks a little something like this in your trading diary. President Biden discussing healthcare at 2:15 Eastern Time, followed by earnings from Apple, Alphabet, Amazon after the close. The US payrolls report coming up tomorrow. Look out for that. US PMIs and ISM manufacturing numbers as well. And finally, Fed Speak returning with President Daly to round out the week. Look out for our coverage tomorrow. Mohammed Al-Arian, Rick Reeder, Anastasia Amoroso, Mike Collins, all on deck following payrolls. Payrolls tomorrow. Looking forward to that coverage with you live from New York. This was the countdown to the open. This is Bloomberg.
why a book about YouTube now? Why'd you do this project?
Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat, are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking, the bus was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Weinergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there, like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is, when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and, well, space is really big. And then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And then they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation was exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that They're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African-American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. Education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, a language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
refer to the dictionary also, okay, and find out the new meanings. As well as describe about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be in the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or a musician in this world. So these are the positive images that are associated with identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, She came to the Gauridoddi campus and then she toiled very hard for 1 year despite many problems. And today I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. At Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities and most of them got institutionalized now. So for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students so that whoever is interested in whatever activity they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change all that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university and then I faced worst form of discrimination in the universities. And there were in those days I'm talking about. So the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand and then again try to excel in academics day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park, and a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. You have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges, or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you post it on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while, and I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Via and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了，你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G, and it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice: nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference. It causes different psychology, and live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。
不管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高。但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the year through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of like losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers. The queen of live streaming, Via, she is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes, and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan. The king will be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce, and he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Via and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的收入是比普通的工作要高很多。但是呢，主播这个工作时刻对身体，包括对精神都有很大的一个考验的。就是每天需要集中精力，然后长达5-6个小时，这种状态是很累的。而且这5-6个小时的话，你是脑子是不停的，然后嘴巴是不停的，然后手也是不停的，眼睛也是不停的。像我们做主播，不是说单一的只做直播一件事情，然后还会有选品的一些工作，然后还会有一些其他的事情排在里面，其实是没有个人生活的。那我觉得增强粉丝影响力的话，不是说某一件事情。可能今天做了什么事情你就增大了影响力，而是每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
没有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy, and they need to show in some ways that they're authentic, right? So for Via and Li Jiaqi, they're able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products because to him that's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是你一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things because you see it live. Something we call social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. and they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top-tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows. And we see like P&G have their own sales room, which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming is definitely transformed the way product owners can think about how to reach their consumers. And it enables a lot of players to actually sell.
Live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。接下来大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaxi's numbers or Lia's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?
The sea is a very challenging environment within which to operate a power project. So seawater is corrosive and conditions are very rough. So this means that power projects don't have a very long lifetime, and it increases operating and maintenance costs.
Partly because of that, many early wave energy projects hit rough waters, such as the Palamas Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best.
Finland-based AW Energy is a veteran in the sector. The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusaari observed the strong back-and-forth movement of a hatch cover in a shipwreck in the Baltic Sea.
The waves are generated far from the coastline, so the wind blows on the surface of the water, causing the water particles to rotate, and that rotation extends deep down below the surface, and the waves can be very long. They can be several hundred meters long. And as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. But there's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters of Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscaled device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming into our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company Eco Wave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Ina Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1986, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Ina wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
Solar and wind energy were fully commercialized. There were a lot of amazing technologies implemented everywhere. I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Inna co-founded EcoWave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties, and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring, or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station. This is the EcoWave Power conversion unit that has been operating in Jaffa Port since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built. The higher the waves, the higher the pressure, which is used to turn the hydro motor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level and keeps them in the upward position until the storm passes.
The company has been operating a 100-kilowatt grid-connected device in Gibraltar since 2016, which is enough to power 100 households. Currently, Inna and her team are working on another 100-kilowatt project at the port of Jaffa in Tel Aviv.
The project will be also the first time in the history of Israel that wave energy will officially connect to the electrical grid. And our goal going forward is to expand it to all suitable breakwaters in the city of Tel Aviv and to supply a significant part of the city's electricity needs.
Today, engineers and entrepreneurs are still trying to crack wave energy. Globally, only a few hundred kilowatts of wave energy are deployed, compared with gigawatts of offshore wind. But the field has come a long way in recent years, and with the right engineering solutions, this new power source could eventually become competitive with more mature renewables like solar and wind.
I would have a lot more confidence in the success of wave energy companies today as opposed to like 20 years ago. But in the next few years, or maybe the next couple of decades, it will be more likely to be used in remote locations like islands that are otherwise dependent on expensive diesel power, or out at sea on gas decommissioning rigs, or for powering underwater autonomous vehicles.
So definitely, wave energy can compete with other renewable energy sources, but I personally believe that this is not a competition. In order to have a 100% renewable energy friendly world, we need all renewable energy sources to work together.
from? Where are all these people from?
So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of Machiavellian companies where, you know, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He is making you, but you act for Nissan. I mean, it's corrupt. The system is...
One of the most dramatic elements was Ravinder Passi's home being raided by court officials in Yokohama.
You scared my wife. You scared my children. I worked in Nissan for 16 years.
So Rav Passi's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn. And he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Passi. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, you know, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government, there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way, it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Passi was tasked with investigating Carlos Ghosn, and he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
It's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Harinada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian.
Hello, Mr. Hari.
And he had a meteoric rise through the company and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Harinada was somebody who actually recruited me into the company, so I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Harinada had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Harinada had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Passi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
I had discussions with Harry, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because me, members of my team, were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon, I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered for me the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board, and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Goan Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who'd spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? You know, this isn't a car company. This is not the KGB.
I think it's fair to say that Rav Pasi didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Hari Nada is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think, he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And you got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera to me.
It's a very sad thing.
It's a family feud.
A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against J.P. Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth in around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going, and I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with J.P. Morgan letterhead, and just started sitting at the kitchen table just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, J.P. Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to J.P. Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the J.P. Morgan. They're now investigating them. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid, too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in J.P. Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with J.P. Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as J.P. Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from J.P. Morgan. They issued an award of about $19 million. I reached out for comment, and J.P. Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. Seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself. And at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s. When everyone had a nickname, his was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. They didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top 3 amongst that, was very successful and made very large amounts of money as a young man. But inevitably mechanization and the arrival of electronic markets was the kind of death knell for the pits, and in 2005 the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, drinking buddy's son, or they're his own kids' friends from football. They're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but it's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil was going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37, and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. The law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had is kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2, 3.
If you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work, Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system, and you end up in sort of a race to the bottom, and that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
the Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
This is a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes. It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got up to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so. And came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was like, is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single supercity economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. In a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. And I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe.
On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them there and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's been super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $79 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way to the supply chain fuel was now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop
using
money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, it's kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial, it'll never be supplied in the quantities we needed, you know, blah, blah, blah. Now we know, let's take action. It's practical, it's implementable, let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, you know, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn their gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know
Mr. Force,
which is declining in value.
You don't have enough of it, right, to power the world.
Yes, that's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down. Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's World headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the Snam model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create the infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia's very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in a few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling costs of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working in that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert, Meredith Annex, and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everybody, live from the Bloomberg Interactive Brokers studio, streaming on YouTube and Bloomberg Originals. It's a big day. It is Thursday, February 2nd, 2023. Man, risk on trade.
What is this, 2021?
Irrational exuberance?
I don't know, but something is happening here.
Something is
We'll
happening.
see who's right and who's wrong.
NASDAQ headed for a bull market, the NASDAQ 100. So we're talking about a 20% move from that bottom. And we've got a couple of really big hours over the next three. And that's in large part by a couple of different things, some big earnings. But we've also got Kathy Wood of ARK Investment. She's going to join us for a deep dive. She's also got her big ideas for 2023. So we've got some big ideas of where we want to go. We want to talk to her about Bitcoin. We want to talk to her about Tesla and so much more.
And you said some big earnings after the bell, Carol. How does $4.7 trillion in market value sound to you? It's Alphabet, Amazon, Apple, and more, all reporting after the close today.
That's my universe right there, my
Well,
world.
I think that's why it's worth $4.7 trillion.
All right, speaking of big tech, Meta on a tear, bringing back flashes of big tech heydays. Is the enthusiasm warranted? And then, Tim, we've got the cover story.
Yeah, I really asked the question, is Wall Street making the same bet that's burned it repeatedly? We're going to dive into that with Liz McCormick.
We've seen this movie before, kids. All of that to come. We begin with a check on the trading day and the rally. Here is Charlie Bellett.
Thank you very much. Lots going on. If there was ever a day to keep it locked into Bloomberg Radio, this is it. Meta Platforms. You mentioned that, Carol, up 27%, but the year-to-date number up 62% now on Meta. Right to the numbers here. We had the Dow positive moments ago, down now by 1 point, little changed. S&P up 74, up 1.8%. But the big story, the NASDAQ Composite Index now surging 446 points, up by 3.8%. The NASDAQ 100 Index outperforming, up 4.1%. Russell 2000 up by 2.4%. 10-year yield 3.39%, with the 2-year yielding 4.08%. Spot gold down 1.7%, 19.17 the ounce, and West Texas Intermediate crude oil up 0.4%, 76.71 a barrel on WTI. As for the overall market backdrop, following yesterday's J. Powell news conference, Danielle DiMartino Booth is chief strategist at Quill Intelligence.
Financial conditions have given back everything all the way until February of 2022. It's as if the Fed has not hiked up 1 basis point. Forget 25 or unusually large 75 times 4 plus 50 plus 25. But he did say that he anticipated that in time, ultimately, financial conditions would reflect the restrictive stance of monetary policy. Again, yesterday was just wishy-washy.
Nothing wishy-washy about Meta Platforms, up 27% right now. And by the way, coming up 3:30 p.m. Wall Street time, major interview here on Bloomberg Radio, which you cannot ignore. Bloomberg Business Week interviews ARK Investments' Kathy Wood. No doubt we'll be asking her thoughts on Tesla, her biggest bet. The ARK Innovation ETF surging today. We've got ARK up now by 8.8%, Tesla up by 7.3%. ARK, by the way, up 45% year to date. And that is a Bloomberg Business Flash.
Right, that ARK Innovation, best month, January, ever since that fund began back in, I think, 2014.
We should ask Kathy about that.
We will. She will be joining us on our Bloomberg TV and radio simulcast, YouTube, as well as Bloomberg Originals. So stick around, 3:30 p.m. Wall Street time. In the meantime, let's do it, guys. Let's get to the Market Drivers Report. Let's set your Business Week agenda. Kriti Gupta, anchor and markets correspondent, Bloomberg, coming off a killer show on Bloomberg TV here in our Interactive Brokers studio. Out there in D.C., our 99.1 studio in the nation's capital, Michael McKee, international economics and policy correspondent at Bloomberg. Kriti, we got to kick it off with you. I mean, this rally. I mean, it is broad-based. How much momentum behind it?
It is broad-based, and it's really important to mention. Let's just put some numbers here. The S&P 500 up 1.7%. The NASDAQ more than doubling that, almost up about, well, I'm doing my math wrong, almost doubling that, up 3.7%. Still nothing to scoff at. And that, too, to your point, with some very heavy volume. Get this. The S&P 500's volume on a 10-day average up 45%. This is what conviction looks like, folks. It means that people are buying a lot very quickly. They're diving into the market. The only hesitation I have in this particular rally is that it's not a broad rally. This is a tech-focused rally, and this is a defensive rally. If you are looking at the likes of healthcare, energy, consumer staples, those are the bets on essentially the American consumer. Those are all in the red today, and they're underperforming by a big margin.
Can I ask you just how much of it is a short play?
A lot of it's going to be a short play. A lot of this is coming, though. I mean,
short squeeze, short covering.
Some of it is short covering, but look, a lot of this came after Meta. So you saw a lot of people, from what I hear, just from my sources, putting on a lot of the bets this morning that are then going to get covered after the bell tonight. Some of this is really getting ahead of the earnings story. So if you see, hypothetically, I don't know what the results are, but hypothetically, if some of these big earnings after the bell, Alphabet, Apple, Amazon, come in really hot and you see a sell-off, it's because it's priced in right now.
Okay, that's good to know.
Yeah.
Michael McKee, come on in here because you're still down in Washington, D.C. after spending the last few days down there covering the FOMC policy meeting, the first one of the year. We all know what happened yesterday, but what do FOMC officials, in your mind, think when they say when Fed Chair Jay Powell says what he said yesterday? We've still got work to do. We've got a long way to go. We could continue to see rates higher. What do they do when they see a rally like this?
They say, good for you. You made some money.
Nice.
This is all a question about not what they say, but what you hear. Jay Powell said, we're going to raise rates more. Powell and his colleagues said, we're going to raise rates more. And he basically said, we're going to get to 5%. We're going to leave rates there probably for the rest of the year. At least that's what we're thinking right now. But if we're wrong, and the market thinks we are wrong, if they turn out to be right, then we'll rethink our strategy. That last part is the only thing that traders hurt. And so you have this reaction today. It's like, oh, the Fed is going to agree with us and they're going to be cutting rates. We don't know yet. The Fed's time horizon at this point is out to March 22nd. That's their next meeting. Whereas, you've got futures already trading Fed rate cuts in September. So they're sort of not talking on the same wavelength. I said earlier today, the Fed is from Mars and traders are from Venus. And that's
like that, Mike.
Kind of, I think, what's going on here.
That's perfection, Mike, in how you explain it. I mean, the economic data dump, I was going to say.
It has.
It was a little bit
we'll
of
get some tomorrow.
A dump today and a big one tomorrow. What story does it all support?
Well, it does support the idea of perhaps a soft landing and perhaps that inflation is going down because we saw a significant rise in productivity, which is the best way to get inflation down. Companies can pay you more if they are making more by using less inputs. And so the 3% rise in productivity in the fourth quarter after a revised higher third quarter productivity report is good news. Unit labor costs, part of that number as well, also falling. So the signs today are we're kind of going in the right direction. And at the same time, you've got jobless claims still telling the story that we don't have a terrible labor market yet. So right now, it looks like it's Jay Powell's world, and we're just living in it. The people in the markets are going to profit off it while they can.
Well, they can is the key phrase there, Creedy.
Interesting.
We're at the highest on the S&P 500 since August of 2022.
Yeah.
Like Carol said, the NASDAQ 100 up 20% from its December lows. I mean, do we see the Fed coming out and derailing this in any way in the coming days when we start to hear more and more from Fed speakers?
Well, it's almost the opposite, right? Because it's the fact that they didn't derail it or Jay Powell didn't go harder on the idea of looser financial conditions when he was asked that's potentially fueling the sentiment behind this rally. So it's not just your tech story, but the idea that he was kind of like, okay, well, moving on. And that is the piece that they're holding on to. If you talk to traders on the floor right now, they're saying, we were expecting hawkish. The bar was already extremely high, and it dropped below. So it's almost, to your point, the opposite.
Well, and Creedy, one thing I want to ask you, and we're going to get into this with Randy Watts later, I do wonder if technically, on a technical basis, this is a healthy rally. And I guess I also think about what Gina Martin-Adams always talks to us. Watch margins, watch the fundamentals, especially as we work our way through earnings season. Do the fundamentals justify this bump up that we've seen?
Well, the way the fundamentals, at least from a market perspective, I'm sure Michael McKee is always like, oh, Wall Street, those guys. It's important from a fundamentals perspective because the tech, what's been priced in for the tech space is just there's higher rates, but that the investment that you're going to see is going to slow down. The slowdown hasn't happened yet because you're starting to see them still beat on their earnings when it comes to sales.
Right.
That's the difference. So the fundamentals are supporting it, but the question is for how long? That's the issue.
Should we go back to?
I got to.
Yeah, go ahead.
Can Can I jump in here
Yes.
and argue something with not just Critty, but with Diane DiMartino Booth, who was on Charlie's newscast. The financial conditions piece of this is a little strange because there are about 7 different financial conditions indexes, all of them constructed differently, and they're telling different stories. If you look at the Bloomberg Financial Conditions Index, which is heavily weighted towards equities, it shows that the financial conditions have loosened to the point where they were in March of last year when the Fed started raising rates. You look at the Goldman Sachs one, and it's significantly tighter. And I think that was what Jay Powell was referring to yesterday. So the financial conditions situation is kind of a hard argument to make because you can easily cherry pick an index that you want to talk about and say that's not working. What the Fed is looking at is, well, we've gone 450 now, 475 basis points, and we are seeing inflation start to come down in many different areas. So what we're doing is kind of working at this point.
Well, to your point, Mike, I completely agree. The equity piece of the equation is really crucial. And Cameron Kreis brought this up, our macro man column writer and strategist. And he said, look, it's the equities portion, but it's also the credit spreads portion. Because if you look at high yield credit spreads, a good chunk of the move is coming from there as well. So we always kind of say, I mean, there's this joke, but not joke on Wall Street, that is essentially the bond market knows better than the equity market. The bond traders are like, oh, those equity guys. But if you actually look at what the bond market is pricing in, they're pricing in the exact same thing as the equity market, which is the Fed is going to cut in the fall, and therefore adding to the move you're seeing in financial conditions.
The Fed says otherwise. Jay Powell says otherwise. And they say, you know, look at that dot plot. We'll see if we get a revision come March. Guys, thank you so much. Mike, I know you've got a busy day ahead of you, and we'll be looking forward to your reporting, both of yours, tomorrow. Kriti Gupta, anchor and markets correspondent at Bloomberg, here in our interactive broker studio. Mike McKee out there in our 99.1 studio in Washington. Catch his jobs breakdown tomorrow morning. He's our international economics and policy correspondent. Can we talk Meta up 26% today?
Yeah, it's pretty wild. It's on track to post its biggest single-day gain in almost a decade. This after CEO Mark Zuckerberg laid out plans to make the social media giant leaner, more efficient, and more decisive. Hey, Carol, it also didn't hurt that the first quarter projected revenue is in line with analyst average projection, and that the company boosted its stock buyback by a cool $40 billion.
All right, let's get to it. Bloomberg News big tech team leader Sarah Fryer is with us from our 960 studio in San Francisco. Sarah, of course, you know, author of No Filter, the inside story of Instagram. Sarah, unbelievable and eye-popping. We saw it when the company reported last night after the close. Fundamentally, did we get something new about Meta and its outlook last night?
Well, what was really new is just this change in tone from Mark Zuckerberg, because for the past year, he's been talking about the road to the metaverse and how it's going to take a long time and take a lot of investment, but eventually it will be worth it for all these investors. And the investors were looking at that and saying, are you looking at the economy, Mr. Zuckerberg? Like, do you see that this is not the time to be throwing your money at something that may not happen? And it seems like Zuckerberg has changed his tone. And in this call, he mentioned the metaverse barely, but he was mostly focused on what he called the year of efficiency, on getting rid of any sort of blocks to getting work done, becoming a leaner organization, getting rid of middle management.